All right, let's get right into it. Welcome to the Power Trading Desk Master Program. I'm a consultant with Durga Analytics, and over the past couple of decades, I've pretty much lived on the trading desk, trading physical and financial power, designing ETRM systems, and building desks that don't just survive, but actually make money. Today, we're kicking things off with Module 1, Chapter 1, Why the Physical System Drives Price. Just to give you a quick lay of the land, this program is a massive, sequenced journey. We're talking 13 modules, 234 chapters. We start with the bare metal physics of the grid, and we build all the way up through strategy, valuation, risk, ETRM tech, and organizational design. But right now, we are at the absolute starting line. Because if you don't get this fundamental concept right, literally nothing else on the desk is going to make sense.
So here's our game plan for this chapter. First, a welcome to the desk. Then we'll hit flow, not a stock, run through the 3 key physical realities, look at pushing system limits, dive into reading the physical system, and wrap it all up with some common pitfalls and next steps.
Okay, starting off with Section 1. Welcome to the desk. The rookie versus veteran mindset. You know, most newcomers walk onto a power desk and they think it's going to be just like trading equities or FX. They sit down expecting the price on their screen to move nicely with financial sentiment, the daily news cycle, or trader flow. Well, let me save you some pain right now. It doesn't. A power price is actually the visible output of a massive physical machine. We're talking about a continent-spanning network that is desperately trying to balance generation and demand every few seconds. If you don't intuitively grasp that physical machine, the numbers blinking on your screen will look completely random, and honestly, you'll probably blow up your book in a week. So burn this axiom into your brain. Electricity is a flow, not a stock.
Moving right along to Section 2, Flow, not a stock. Let's think about traditional storable commodities for a second. If you're trading oil, you've got giant tanks. Trading wheat, you've got silos. If a massive demand spike hits or there's a sudden supply shock, you just draw down on that warehouse inventory to absorb the blow, right? Power doesn't have that luxury. Electricity, at least in any meaningful system scale quantity, just cannot be stored cheaply. Whatever is generated has to be consumed instantly. There is absolutely no warehouse inventory to act as a shock absorber. Supply and demand have to match continuously, in real time, or the grid literally collapses. And because there's no physical buffer, price has to do all the heavy lifting to balance the market. And believe me, it does so violently.
Which brings us to Section 3, 3 key physical realities.
These 3 realities are the invisible hands shaping every single power price. First up, non-storability. Like we just talked about, no inventory means no cushion. Price absorbs every single imbalance. Second, instantaneous balancing. The system operator, an ISO in the US or a TSO in Europe, has to force supply to equal demand second by second. That means timing is literally everything. A megawatt of power at 7 p.m. when everyone's cooking dinner is a completely different financial asset than a megawatt at 3 a.m. And third, network constraints. Power flows over a physical grid of wires, and those wires have hard thermal limits. Where you inject that power and where you withdraw it matters immensely. Grid congestion can make the exact same megawatt worth drastically different amounts just a few miles down the road.
All right, Section 4, Pushing System Limits, the worked example.
Let's put some numbers to this and look at 2 different days on the exact same power system. Day A, the weather is mild, demand is sitting at a very comfortable 28 gigawatts, and there is abundant, cheap wind and natural gas flowing. The price? A calm $25 per megawatt hour. Now fast forward to Day B, a massive heat wave hits. Demand surges up to 41 gigawatts. The wind completely dies down, and suddenly the grid operator is panicking, firing up these old, wildly expensive oil peaker plants just to keep the lights on. The price explodes to $300 per megawatt hour. Now, here is the absolutely crucial takeaway. Zero financial news changed between day A and day B. No central bank pivot, no shift in market sentiment. That massive 12 times price spike was purely driven by physical reality. A rookie staring at their screen just sees total chaos. But a veteran? A veteran watched the weather models and saw that spike coming days in advance. When you map out how price behaves as the system is pushed toward its limits, it paints a very clear, non-linear picture. Imagine a hockey stick curve. On the flat part of the curve, the system is totally comfortable. Cheap, flexible generators are easily meeting demand and prices barely budge. But as demand cranks up and you get pushed to the right side of that curve, the system loses its slack. We hit scarcity. The operator is forced to turn on the most expensive, inefficient generation units they have. And that is exactly why price doesn't just drift up, it skyrockets. The moment the system runs out of physical slack, the price action becomes explosive.
Let's dive into Section 5, Reading the Physical System, Desk and Enterprise Reality. So how does this play out on a professional desk? When a power trader sees a massive price spike, their first instinct is never, hey, who's buying? That's equity brain talking. The power trader instantly asks, wait, what just changed on the system? Did a nuclear plant just trip offline? Did the wind die? Is a heat wave settling in? The physical cause almost always explains the market move before you ever need to invent a story about market behavior. That price on your screen, it's really just a laggy summary statistic of the underlying physical grid. To survive, you have to read the machine, not just the ticker. And this physical-first mindset scales all the way up to the enterprise level. It's exactly why modern energy trading and risk management platforms, ETRMs, are built the way they are. They don't just ingest trade and price data, they're constantly pulling in live weather feeds, generation availability, and outage schedules. If you're a risk manager, listen up. If you rely on a purely financial risk system that only models historical price time series and it ignores these physical drivers, you're sitting on a ticking time bomb. It will systematically underestimate how fast and how far power prices can actually move. Financial models blow up in power trading because they are blind to the physical limits of the grid. Finally, Section 6, Pitfalls and Next Steps.
There are three major traps I see constantly catching people off guard on the desk. Number 1, treating power like it's a financial-only asset. Sure, market sentiment matters a tiny bit at the edges, but physics completely run the show. Number 2, assuming storability. Yes, grid-scale batteries are growing, but on a national level, electricity is still effectively non-storable. Do not build your trading models assuming there's some magical, massive inventory out there to save you. And number 3, ignoring location. If you assume there's just one simplified price for an entire grid, you're going to get burned. Network constraints dictate that in power trading, location is quite literally everything.
All right, let's test what we've covered with a classic trading desk interview question. Why are electricity prices so much more volatile than prices for storable commodities like oil or gas? Now, the rookie candidate is going to mumble something vague about supply and demand. But a strong candidate, they're going to name the exact mechanism we've been talking about today. The answer is non-storability combined with instantaneous balancing. Because there is no inventory buffer, price is the absolute only variable left to absorb every single real-time shock on the grid.
Which brings us to our ultimate takeaway for today. You simply cannot read a price that you do not physically understand. Getting this intuition locked in is what gives the rest of your trading models, your risk limits, and your strategy something real to anchor to. But this leaves us with a massive cliffhanger. When scarcity actually hits and prices go explosive, exactly which machines are firing up to save the grid and what on earth do they cost to run? Well, that is exactly what we're going to unpack in Module 1, Chapter 2, the Generation Stack. I'll see you there.
Welcome back to the explainer for our Power Trading Desk Master Program.
I'm your host, and as a consultant from Dorga Analytics with decades of experience on the floor, trading power, building desks, and designing enterprise systems, I'm absolutely pumped to take you through this material. We're not here to just memorize textbook theory. We're here to learn how to survive and actually make money on a real trading desk. Today, we're diving into the generation stack to see exactly how the physical reality of the grid directly dictates your financial reality.
Just to ground ourselves in the big picture, remember this program is a massive sequence journey, 13 modules and 234 chapters in total, taking you all the way from grid physics to complex trading strategy and ETRM architecture. Right now, we are in Module 1, Power System Fundamentals, and specifically Chapter 2, the Generation Stack. This sets the absolute bedrock for all the pricing models we'll be building later on.
Okay, here's our game plan for today. First, variable cost drives dispatch. Then, we'll meet the cast of characters, look at finding the marginal price, tackle enterprise ETRM in reality, and wrap up with our key takeaways. Let's get right into it.
Starting with Section 1, Variable Cost Drives Dispatch.
You have to draw a hard line here between fixed costs and variable costs. Now, fixed costs, that's your sunk capital, the concrete, the turbines, the financing. But when it comes to the real-time decision of whether a plant fires up today, this very minute, those fixed costs are completely irrelevant. They're already spent. What actually drives the run decision are the variable costs, mainly fuel, plus operations and maintenance. The power grid is ruthlessly efficient, guys. It always runs the cheapest variable cost units first, period.
And this brings up a trap I see all the time. When I'm interviewing junior analysts or aspiring traders for the desk, I'll ask them, hey, why does a nuclear plant run 24/7 while a gas peaker sits idle? The amateur mistake is saying, well, the nuclear plant was super expensive to build, so they have to run it. No, it runs because its fuel cost is practically nothing. Its variable cost is tiny. On the flip side, a gas peaker might be dirt cheap to build, but it burns expensive fuel, so it only kicks on when prices spike.
Moving on to Section 2, the cast of characters. If you want to read prices accurately on the floor, you need to know who's playing. Look at this stack, ordered conceptually by cost. On the far left, you've got wind and solar, near zero variable cost because, hey, the fuel is free, though obviously they're completely at the mercy of the weather. Next up is nuclear, super low variable cost, but highly inflexible. Then hydro, also cheap and much more flexible, but you're limited by the water in your reservoir. Then we hit coal, mid-range cost, moderately flexible. Next is your combined cycle gas turbines, or CCGTs, the absolute mid-merit workhorses of the grid. And finally, on the far right, your expensive peakers, high cost, highly flexible, and they only run when the grid is literally begging for power.
Now, listen to this closely. Terms like baseload or peaking aren't permanent engineering labels bolted onto a plant. They're dynamic roles. They depend entirely on a plant's variable cost relative to the rest of the stack. Baseload runs almost continuously, mid-merit cycles with daily demand. Peaking only runs when demand is highest. But if fuel prices swing, a plant's role shifts. A coal plant that used to be a baseload staple can easily get bumped to mid-merit if natural gas suddenly gets dirt cheap.
All right, Section 3, Finding the Marginal Price.
Let's put this theory into practice with a live desk-ready scenario. Imagine a simplified system where our target demand right now is 2,500 megawatts. We walk right up the stack, starting with the absolute cheapest generation. The wind is blowing, giving us 600 megawatts. Our nuclear fleet is running flat out, adding 1,000. Then we fire up coal, giving us another 800. If we add that up, 600 plus 1,000 plus 800, we're at 2,400 megawatts. But our demand is 2,500. We are exactly 100 megawatts short.
So what happens? To cover that final 100 megawatts, the system operator has no choice but to call on the next available unit. In our stack, that's the CCGT plant.
Because it's the last unit needed to meet demand, it becomes the marginal unit. And since its variable cost is $48 per megawatt hour, guess what? It just set the clearing price for the entire market at roughly $48 per megawatt hour.
This right here is exactly what seasoned traders mean when you hear them yell across the floor, gas is on the margin. If you ask a pro where the price is on a normal day, they rarely just spit out a number. They'll answer with a fuel. They're mentally running this exact calculation, reading the stack against current demand, seeing what's firing last, and estimating the price. You have to translate the physical reality into a financial price, not the other way around.
Section 4. Enterprise ETRM and Reality.
Taking that clean mental math and putting it into a highly functioning enterprise ETRM platform introduces some brutal operational realities. In a real system, the generation stack isn't just a concept. It lives as critical reference data. Unit capacities, heat rates, fuel linkages, real-time availability. You need rigorous governance over this, because keeping that data meticulously clean is the only way your fundamental models can accurately estimate marginal costs. Good data governance isn't a boring IT afterthought. It's a money-making discipline. Bad data means a bad stack, which means you're going to lose trades.
Just look at the clean model versus messy reality. In a pristine textbook, you have perfectly known variable costs and a flawless merit order. Out on the desk, it's messy. Intraday fuel prices are jumping around. Plants are running a part load, which totally messes up their efficiency. And availability data is notoriously incomplete. A plant could trip offline without warning the second you initiate a position. The merit order in your system is always just a highly educated, data-driven estimate of the real one.
Let's bring it all home with Section 5, Key Takeaways. Here's what you absolutely must remember to analyze these markets effectively. 1. Dispatch is driven entirely by variable cost, not sunk capital. 2. The stack always runs from near-zero renewables up to the highest cost peakers. 3. Roles like baseload and peaking are relative and dynamic. They change when fuel prices change. And finally, altering the generation mix, like pushing in more renewables, completely reshapes the entire price distribution and volatility you'll be trading against. Which brings us to a massive, multi-million-dollar question as we look ahead to Chapter 3. If we know that variable cost drives everything, how exactly do we calculate those precise thermal generation economics down to the penny in a constantly shifting market? Think about that, and I'll see you in our next explainer where we're going to break down the exact math. Welcome back to this explainer, where we're continuing our journey through the Power Trading Desk Master Program. I'm a power trading and risk management consultant from Dorga Analytics, and with decades of experience building and running trading desks, I'm absolutely thrilled to guide you through this material. Today, we're diving into Thermal Generation Economics, which is Module 1, Chapter 3. And look, we're going to tackle this not just from some academic textbook perspective, but from the gritty reality of a live trading desk, the kind that actually makes money and, more importantly, survives the long haul. Just as a quick reminder, this entire program is a sequenced masterclass spanning 13 modules and 234 chapters. We're moving all the way from the physical realities of the grid, right through strategy, valuation and risk, to execution, ETRM technology, and enterprise architecture. Right now, we are laying that crucial foundation in Module 1. Okay, let's take a look at our agenda for today. We're going to pinpoint the margin, really understand heat rate, calculate our variable costs, look at the merit order reshuffle, and finally, tie it all back to desk operations and your ETRM systems.
Section 1. The Desk Master Program. Pinpointing the margin.
Section 2. Understanding heat rate, which is literally the engine of our economics. So why are we focusing so intensely on this? Well, it's because thermal plants, specifically gas and coal, are on the margin in most hours across most markets. They are the units setting the price you're going to trade. To anticipate short-term power prices, you have to master heat rate. A thermal plant is never perfectly efficient, right? It burns fuel to make electricity, and a lot of that energy is just lost as heat. Heat rate measures that exact efficiency. It tells us precisely how much fuel energy it takes to squeeze out 1 unit of electricity. It's the ultimate bridge between the fuel market and the power market. On the desk, we almost always talk about this in MMBTU. That's million British thermal units per megawatt hour.
Now, you need to hardwire this inverse relationship into your brain. A lower heat rate means a more efficient plant. It takes less fuel to produce the same amount of power. That efficiency metric dictates exactly where a facility sits in the dispatch stack, or the merit order. Think about it. 2 gas plants could be buying the exact same gas at the exact same price, but the one with a lower heat rate, it has a significantly lower running cost.
All right, moving on to Section 3, calculating variable costs, from math to money. This right here is the fundamental arithmetic that turns physical grid dynamics into actual P&L on the trading floor. Step 1, you take your fuel price and multiply it by your heat rate. That gives you your basic fuel cost. Step 2, you add your variable operation and maintenance costs, your variable O&M, things like chemicals, water, general wear and tear. Step 3, you arrive at your total variable cost per megawatt hour. That number is your break-even price to run the plant. Let's ground this with some real numbers. Imagine we've got an efficient combined cycle gas turbine, a CCGT, with a heat rate of 7.0 and a variable O&M of $3. If you're buying gas for, say, $4.50, your variable cost is exactly $34.50 per megawatt hour. It's just $4.50 times 7 plus 3. It's simple, it's clean, and it's highly predictive of exactly where that unit is going to bid into the market.
But here is where it gets really fascinating. Watch how sensitive this formula is to the underlying fuel market. If that gas price spikes overnight from $4.50 to $7, your variable cost suddenly jumps to $52. A 56% rise in gas drove an almost identical 51% rise in the plant's running cost. Fuel absolutely dominates this math. It intrinsically links power and gas prices together, which is a dynamic we'll be actively trading when we get into spark spreads in Module 4.
Section 4, the merit order reshuffle, playing the stack.
Take a look at that steep green line representing an 11.5 heat rate peaker plant. At $7 gas, its fuel cost alone explodes to $80.50. It is incredibly sensitive to gas price increases. This perfectly illustrates why an inefficient peaker sits at the absolute top of the stack. It's only going to turn on when power prices are sky high during extreme peak demand.
Now, because these running costs are so deeply tethered to fuel, when gas gets cheap relative to coal, the whole stack reshuffles. Suddenly, efficient gas plants have a lower variable cost than the coal plants, so they slide right down the merit order and dispatch first. This is called gas-to-coal switching. It's a highly tradable, real-time dynamic that fundamental analysts and traders are constantly watching to capture value.
Let me give you a bit of desk insight from my years on the floor. When a massive, efficient unit unexpectedly trips offline, a junior trader is going to look straight at the megawatt loss. But the veteran's reflex is to ask, okay, which heat rate now sets the margin? Losing an efficient CCGT means the grid operator is forced to rely on a less efficient unit further up the stack. That lifts the clearing price dramatically, even if there's still plenty of total capacity left on the grid. Honestly, the megawatts lost matter way less than the heat rate of what replaces it.
Section 5, desk operations and ETRM, taking the enterprise view.
On the desk, heat rates are absolutely core reference data in your ETRM stack. You'll deal heavily with the market implied heat rate, which is simply the power price divided by the gas price. We use this because forward curves for power are frequently built off liquid forward gas curves multiplied by this implied rate. If your stored heat rates in the ETRM are wrong, I guarantee that error propagates straight into your forward curves, completely corrupting your valuation and your value at risk metrics. And hey, time for a quick reality check on model skepticism. The heat rate formula? It's exact on paper. But real physical plants? they deviate. The nameplate heat rate provided by the manufacturer is a best-case scenario. In the real world, a plant's heat rate worsens when it's running at part load or during a massive summer heat wave. Desks rely so heavily on market-implied rates because actual real-time physical unit performance is just incredibly hard to observe from the outside.
Before we wrap, you need to beware of common pitfalls that will absolutely sink your operational models and your job interviews. The biggest one, mixing up BTU per kilowatt hour and MMBTU per megawatt hour. Guys, that is a factor of 1,000 difference. A unit error there will entirely blow up your downstream analytics. Also, never ignore variable O&M just because it seems small. It can easily flip a close gas to coal switching decision. And, as we just covered, never assume a plant's heat rate is perfectly fixed regardless of weather or load.
So, we've successfully bridged the fuel market to the power market using the engine of heat rate, and we understand the costs. But here's the critical question I want you to ponder. We know how thermal plants are priced, and we know gas and coal set the margin. But what about those massive units sitting at the very bottom of the stack? Keep this cost engine fresh in your mind as we transition to Chapter 4, where we are going to unpack the immovable economics of nuclear and baseload generation. Thanks for joining this explainer, and I'll see you in the next chapter.
Hey everyone, welcome back to the Explainer. I'm throwing on my Durga Analytics consultant hat today because we need to bridge a massive gap between actual grid physics and the reality on the trading desk. If you've spent any time around physical or financial power trading, you know the golden rule. The electron flow completely dictates the money flow. So today, we're unpacking the absolute foundation of that physical flow. Just a quick reminder of where we are. This explainer is part of our comprehensive Power Trading Desk Master Program. We're talking a massive, sequenced journey. 13 modules, 234 chapters, taking you from the physical realities of the grid all the way through trading strategy, risk management, ETRM technology, and enterprise architecture. The whole shebang. We ground everything in modern professional practice because the goal here is to help you build and run a desk that actually makes money and, survives. All right, today we're focusing squarely on Module 1, Chapter 4. We are getting hands-on with the foundational floor of the power market, which is nuclear and baseload generation. Honestly, understanding this is absolutely critical, whether you are an aspiring trader, an originator, or sitting in risk management. Because look, if you don't understand the bottom of the generation stack, your models for the rest of the market are guaranteed to fail. So here's our quick roadmap for today. 1. Why baseload runs flat. 2. The negative price reality. 3. Inflexibility shifts the burden. 4. Risk models and strategy. And 5. Key takeaways. Section 1. Why baseload runs flat. Let's start right at the underlying economics. The core driver for nuclear plants, and really baseload in general, is their incredibly high fixed construction costs, contrasted with very, very low variable costs. In practice, this means the economics force them to run as much as humanly possible. They have to generate massive volume at a tiny marginal cost just to pay off that initial capital outlay. Plus, they are technically inflexible. Ramping a nuclear reactor up and down, it's slow, it's highly constrained, and operationally, it's just a nightmare. You can think of baseload as this massive, unmoving block running at a near constant output around the clock. It's just a flat band of generation pushing electrons onto the grid, completely ignoring the daily ebb and flow of human activity. It literally does not care that everyone has gone to sleep. And it's not just nuclear, by the way. Other units might be must-run for non-economic reasons. Think of combined heat and power plants supplying an industrial host, or thermal units that the grid operator orders to run just to maintain local stability. Moving right along to Section 2, the negative price reality. So, things get really interesting when that inflexible block of generation collides with a sudden drop in demand. Let's look at a real, practical, worked example from the overnight shift on the desk. Right around the time you're desperately reaching for your third cup of coffee. Imagine overnight demand falls to 22 gigawatts. But out on the grid, we've got 18 gigawatts of must-run nuclear and 6 gigawatts of zero-cost wind, all trying to push power. That's 24 gigawatts of generation, desperately trying to squeeze into 22 gigawatts of demand. Basically, something has to give.
Here is the crucial sequence, with 2 gigawatts of excess supply that fiercely prefers to keep running. The clearing mechanism of the market literally forces the price below zero. Think about it. In a market where subsidized wind wants to keep generating to earn tax credits, the grid operator will push the clearing price negative. They're essentially saying, hey, we are going to charge you to put power on this grid. And they'll keep dropping that price until exactly 2 gigawatts of supply finally throws in the towel and curtails.
Now contrast that 2 a.m. overnight reality with the exact same physical system at 7 p.m. Evening demand hits 41 gigawatts. To meet that, the system has to reach way up into the expensive peaking plants, setting the price super high in the stack. It's the exact same baseload plants on the exact same day, but we are at totally opposite ends of the price distribution simply because of where demand sits relative to that inflexible floor. All right, section 3. Inflexibility shifts the burden.
Because must-run baseload cannot easily move, it effectively shifts all the heavy lifting to the rest of the generation stack. The entire burden of following those massive daily swings in human demand falls squarely on mid-merit plants, peakers, and energy storage. Basically, the less flexible the bottom of your stack is, the more the top of the stack, and consequently the price itself, must do the incredibly hard work of balancing the grid.
This insight is absolutely vital for anyone stepping onto a trading floor. If you see persistent negative off-peak prices in a region, do not assume your data feed is broken. Negative prices aren't a glitch, guys. They are a structural feature of having too much inflexible must-run generation and subsidized renewables competing for thin overnight demand. That structural reality completely dictates how you have to price your off-peak blocks. Okay, section 4, risk models and strategy. So how do we apply this physical grid reality to our enterprise risk systems? First off, you must maintain strict model skepticism on the desk. A massive, fatal pitfall is assuming prices simply stop at zero. They regularly don't. If your ATRM system or your risk limits cannot represent negative prices, you are going to completely misprice your off-peak exposure. Another huge flaw? Treating baseload as a marginal price setter during peak hours. Baseload sets the floor, it almost never sets the price when demand is high. Now, if you're an originator or a trader hedging multi-year positions, you have to project how announced baseload retirements, like a major nuclear closure, will fundamentally change the shape of the forward curves. When baseload retires, the floor of the market can rise, and the entire price profile changes shape. Conversely, if a market adds a ton of inflexible, low-cost output, it can vastly deepen those off-peak price troughs. By the way, if you ever get this classic question in an interview for a power desk, why on earth would a generator produce at a negative price? Remember the operational reality. Generators effectively pay to keep producing because shutting down a massive thermal plant and restarting it the next day is vastly more expensive and honestly physically damaging to the equipment than simply eating a brief negative price for a few hours overnight. Finally, section 5. Key takeaways. Let's lock in the key takeaways from this explainer before you go open up your risk models. Remember, baseload inflexibility sets the market floor. Excess must-run generation combined with renewables will drive off-peak prices below zero, and that is a totally normal feature you must explicitly model. Because baseload is stubborn, the rest of the stack does all the balancing work. And lastly, always account for how baseload retirements will alter your multi-year hedging strategies. I'm going to leave you with a provocative thought to test your desk readiness. How will your multi-year hedges and risk models survive when the textbook baseload floor collapses into structural negative tails? Are your systems actually ready for a world where the floor routinely falls out? Thinking through that inflexible reality perfectly transitions us into our next chapter.
In Module 1, Chapter 5, we are going to look at the exact opposite end of the flexibility spectrum, hydro and storage hydro, and how desks actually monetize that speed. Thanks for joining me on this explainer, and I'll catch you in the next chapter.
All right, welcome back to The Explainer. I'm your host, a power trading and risk management consultant over at Durgan Analytics. For decades now, I've basically lived on trading desks, trading physical and financial power, and designing the ETRM systems that keep the whole thing running. Today, we're unpacking a topic that literally separates the amateur analysts from the seasoned professionals, hydro and storage hydro. We are jumping right into Module 1, Chapter 5 of our master program. Let's get to it.
Just to quickly anchor us in the big picture, our Power Trading Desk Master Program is a massive journey. We're talking 13 modules, 234 chapters, covering everything from the grid's physical reality all the way through strategy, risk, and building a durable trading organization in Module 13. Right now, we're laying the absolute foundation in Module 1, Power System Fundamentals. And trust me, understanding the physics of the grid right here is exactly what's going to drive your P&L later on.
Okay, here's our rapid-fire roadmap for today. We're going to hit the trap, dive into water value, look at the physical types of hydro, run a real-world desk example, zoom out to market impact, and wrap up with key takeaways. Let's start with Section 1, the trap. Honestly, this is the most common mistake I see junior guys make. Picture this. You're sitting in an interview for a junior trading seat, and the head of the desk leans over and asks you, hey, if a hydro plant essentially has zero fuel cost, because, water is free, why would its operator ever refuse to generate when the market price is a very solid $40 a megawatt hour? The amateur move here is treating hydro like a zero-cost must-run asset. Novices assume that if the fuel is free, any positive price means you just turn the turbines on and print money. But if you make that assumption on a real trading desk, you're gonna get wiped out. Reservoir hydro has a very real cost. So how do we avoid that trap? That brings us to Section 2, Water Value. This requires a complete paradigm shift in how you think.
Think back to Chapter 3 when we covered thermal economics. For a gas or coal plant, the math is instantaneous, right? You run if the market price beats your variable fuel cost. But hydro? It completely shreds that run cheapest first rule. For reservoir hydro, you only run if the market price exceeds your water value. It's not just a little tweak to your spreadsheet, it's a completely different way of looking at time and optionality on the desk.
So what exactly is water value? Put simply, it's an opportunity cost. It is the cost of generating right now versus holding on to that water for a much tighter, higher-priced hour later on. Yes, the water itself is completely free, but it's physically limited. Every megawatt hour you churn out today is one you literally cannot generate tomorrow. The real cost of generating today is the value of giving up tomorrow. It's a game of intertemporal survival. Moving right along to Section 3, the physical types of hydro. Before we run any math, we got to know what our physical toolkit actually looks like. On the actual trading desk, you're going to run into three main types of assets. First up, run-of-river. This has basically no storage. It just generates as the water flows, meaning it's largely non-dispatchable. You get what you get. Second is reservoir, or storage hydro. These actively hold water so you can choose exactly when to run. This is the absolute engine of the water value dynamics we're focusing on today. And third is pumped storage, a true arbitrage play where you're literally pumping water uphill when power is dirt cheap and letting it rip when power is expensive. All right, Section 4. Theory is great, but let's jump into the dispatcher seat and run some real numbers. I want you to imagine looking at a chart of your reservoir levels over the year. It fills up, it draws down. Now imagine a dotted orange line near the bottom. That's your scarcity threshold. As your water levels drop and approach that danger zone, your water value absolutely skyrockets. The operator's looking at this saying, man, I'm running out of fuel for the winter. So to survive, they conserve water, which organically drives up the market price.
Your water value is entirely implied by your future expectations of price and inflows.
Let's put some dollars to it. You're staring at your screens. Current market price is $40 a megawatt hour. But your quant team's model is forecasting a bone-dry, super high-priced winter ahead. Because of that dry forecast, your estimated water value sits at $55. The play here? You hold. You absolutely refuse to generate, even though fuel costs you zero right now, because taking $40 today is a lot worse than the $55 you expect to make if you just sit on your hands and wait.
Now, fast forward 2 weeks. A massive storm rolls through, heavy rain fills the reservoir right back up, and that winter scarcity forecast just vanishes. Boom! Your water value collapses down to $22 a megawatt hour. Now, even with the market price sitting lower at $35, you are generating freely. Why? Because 35 is greater than 22. And listen closely here. Absolutely nothing physically changed about the plant itself. The only thing that changed was your opportunity cost, driven entirely by hydrology and forward curves.
Let's jump to Section 5, Market Impact. Zooming out, what happens when these individual asset choices start dominating an entire market?
In hydro-heavy markets, think Nord Pool over in Europe, the marginal price is almost always set by water value, not by coal or gas. The desk meticulously tracks what's called the hydrological balance. That's your current reservoir and snowpack levels compared to the historical norm. Traders watch this exactly the same way a thermal desk watches natural gas storage. A massive negative hydro balance? That is wildly bullish for power prices.
From an enterprise ETRM perspective, this is wildly complex to model. A dry year forecast will spike prices today way before any physical shortage actually hits the grid, simply because operators immediately start hoarding water in anticipation. Hydro markets are totally path-dependent, so when you're building valuation models for the desk in Module 5, you have to simulate actual hydrology, rainfall, snowmelt, not just instantaneous demand. It turns basic valuation into a massive real options math problem.
Which brings us to Section 6. Let's lock in the key takeaways so you can actually use this on the floor. To survive and make money with these assets, remember these rules. 1. Water value is an opportunity cost, plain and simple. 2. Dispatching a reservoir is all about optimizing across time. It completely breaks the thermal model we learned earlier. 3. Whole markets will track hydrology, meaning droughts lift prices structurally. And finally, keep this in your back pocket. This exact same storage logic, this optionality mindset we're building right now, we're going to use the exact same logic when we value battery storage in Chapter 21.
So hydro shows us how to optimize a limited, stoppable fuel source across time. But what happens when you've got an asset with zero fuel cost, zero storage, and it is completely at the mercy of right now weather? Well, that is exactly what we're tackling next in Chapter 6, Wind and Solar, as we look at the reality of intermittency on the modern grid. I'll see you there.
Welcome back to The Explainer. I'm putting on my consultant hat today, specifically as a power trading and risk management consultant from Durga Analytics, to give your trading desk a much-needed reality check. We're diving into Chapter 6, Wind and Solar. Look, if you're an aspiring power trader, a quant, a risk manager, or working in ETRM, you absolutely cannot model or trade a modern power market without grasping exactly what wind and solar do to price. They are literally rewriting the rules of the game every single day. Real quick, let's orient ourselves in the wider Power Trading Desk Master Program. As you know, this is a massive journey across 13 modules and over 200 chapters. Right now, we're still anchoring ourselves in Module 1, Physical System Fundamentals. We have to nail down the hard physics of the grid before we scale up to market reality, analytics, risk, and our final capstone, where we design a fully functioning trading organization. You just can't build a durable desk without mastering this stuff first. Here's the game plan for today. We're covering the physics of renewables, the merit order effect, the duck curve, new desk risks, and finishing up with key takeaways and pitfalls. Let's get right into it.
Starting right off with Section 1, the physics of renewables. Because on the trading floor, physics drives the price.
The biggest mental shift you have to make as a new trader or analyst is understanding the stark difference between dispatchable and non-dispatchable assets. Traditional thermal plants, your coal and gas, are dispatchable. The grid needs more juice, the operator literally dials them up. But wind and solar? They are entirely at the mercy of the weather. They are non-dispatchable. You can't just call up the sky and ask for another 50 megawatts of wind. You can turn them down through curtailment, sure, but you can never, ever turn them up on demand.
Now, here's where it gets interesting financially. Because wind and solar don't burn any fuel, their variable cost to operate is effectively zero. That drops them straight to the absolute bottom of the generation stack. They run whenever the resource is there. And it's exactly this combination, being the absolute cheapest to run, yet completely uncontrollable, that makes renewables massive price suppressors and huge risk adders all at the same time.
Which brings us to Section 2, the merit order effect. This is the dynamic that's going to dictate a huge chunk of your off-peak trading strategy. So since these zero-cost megawatts pile in at the bottom of the generation stack, they actively push out the more expensive thermal generation that would normally be running. Say you get a super windy day, that zero-cost wind power pushes the marginal unit, the one actually setting the price, further down the stack. A pricey gas peaker gets pushed out, leaving a cheaper combined cycle gas turbine to set the price instead. The entire supply curve shifts to the right and clearing prices tank. On the desk, trading, this is pure instinct. You see a massive wind forecast for tonight? Your brain immediately goes, all right, marginal unit drops. Price softens. Might even go negative, off peak. Seasoned traders play this merit order effect all day long, but they also know the flip side. A sudden, unexpected lull in the wind right at peak demand, the marginal unit climbs rapidly, and prices absolutely skyrocket. I've personally seen a 20-minute cloud cover make or break a trader's entire month. Let's move to Section 3, the duck curve. This is undoubtedly the most visually iconic and economically critical shape in power trading today. To make sense of it, you first need to wrap your head around net load. Net load is simply the total gross demand of the grid minus whatever wind and solar happen to be outputting. Why does this matter? Because that leftover number is the actual physical volume of power that your dispatchable thermal plants have to manage. And that brings us to the famous duck curve. During the middle of the day, solar just floods the system, carving out this massive, deep belly of incredibly low net load. But as the sun goes down, that solar generation vanishes right at the exact moment everyone gets home and human demand peaks. So the net load shoots straight up, creating a violent, steep evening ramp. Let's run some real desk numbers so you can feel the commercial impact here. Say it's midday, gross demand is 30 gigawatts. The sun is blasting, so solar is kicking out 18 gigawatts. That means your net load is only 12 gigawatts. The grid can easily meet that with cheap baseload power. As a result, that midday price gets completely crushed. Let's say it's hovering around $20 a megawatt hour. But fast forward just 5 hours. The sun sets. Gross demand jumps to 34 gigawatts as people crank their ACs and start cooking, while solar output plummets to zero. Suddenly, your net load is the full 34 gigawatts. The system operators are now scrambling to find and ramp up an eye-watering 22 gigawatts of conventional power in a tiny little window. To hit a ramp that steep, operators have to dig deep into the stack and fire up those expensive, fast-acting peaker plants. Boom, the price violently gaps up from that $20 belly to $120 a megawatt hour. So you see, solar doesn't just make midday cheap, it actively manufactures the extreme volatility that makes evening flexibility so insanely valuable. If you're running a battery storage asset charging at $20 and discharging at $120 is your bread and butter. All right, Section 4, new desk risks.
Surviving that evening ramp requires managing entirely new operational realities. Look, your desk has 3 new headaches to manage here. First, sheer intermittency. Weather shifts by the minute, driving wild short-term volatility. Second, forecast error. If you're short power because you expect a wind farm to hit 8 gigawatts and it only delivers 4, you're eating massive imbalance penalties. And third, curtailment. When local solar or wind oversupplies the transmission lines, the grid literally cuts the output. That is just pure lost revenue. If you're building systems or managing risk, understand this. Weather forecasting is no longer a side project for meteorologists. It is a hardcore data engineering problem for your ETRM systems. Weather feeds dictate renewable forecasts, which dictate net load, which drives your price forecasts, and ultimately your value at risk. Weather data is the bedrock of modern risk analytics. And here is a healthy reality check for anyone staring at a screen all day. Day-ahead forecasts always look smooth and highly manageable, but actual real-time weather is chaotic. A sudden pressure drop or a passing cloud bank means that nice theoretical merit order effect hits the trading floor as a sharp, painful price shock. The models look pretty, but reality is messy. Finally, Section 5, Key Takeaways and Pitfalls. Let's bring it all home. If you remember nothing else, avoid these 3 rookie mistakes. Pitfall 1, assuming zero cost means power is always cheap. It's only cheap when it's generating. A wind lull will spike prices instantly. Pitfall 2, confusing installed capacity with available energy. Just because a grid boasts 10 gigawatts of solar capacity doesn't mean it's there to help you during the evening peak. It's non-dispatchable. And Pitfall 3, ignoring the financial pain of curtailment and negative off-peak prices. I'll leave you with the classic desk interview question to chew on. How does a large amount of solar capacity change the daily price shape, and where in the day does flexible generation become most valuable as a result? Think deeply about that duck curve. In our next explainer, Chapter 7, we're moving on to merit order dispatch, where we'll actually plug this net load concept straight into the mathematical clearing engine. Until then, keep your analytics clean, manage your risk, and I'll see you on the desk. Welcome to this explainer on Chapter 7 of the Power Trading Desk Master Program. I'm your host, a power trading and risk management consultant from Durga Analytics. Look, over decades of building and running trading desks, designing ETRM systems, and trading physical and financial power, I've seen exactly what separates the desks that survive and print money from the ones that blow up. And today, we are unpacking the absolute bedrock of power price formation, merit order dispatch. Seriously, if you want to know why your forward curves are suddenly shifting or why your value at risk just spiked overnight, well, it all starts right here. Here's the quick agenda for today's session. We'll hit the master program context, then building the supply stock, marginal unit sets price, why power prices jump, and finally, a trading desk reality check. Okay, Section 1, the master program context. Just a quick roadmap reminder for everyone. This master program is a massive, sequenced journey, 13 modules, 234 chapters. We're covering the whole shebang, from the physical grid all the way through advanced strategy, analytics, execution, and enterprise ETRM architecture. Right now, we are smack in the middle of Module 1, Power System Fundamentals, and Chapter 7 is honestly the conceptual core of this entire first module. Because before you can even think about advanced trading strategies in Module 4 or complex valuation models in Module 5, you absolutely have to master the physical realities of the grid. So let's get into it. Section 2, building the supply step. So every single generator that can run on the grid has a variable cost of production, right? For thermal plants, this is mostly your fuel cost divided by efficiency, that's your heat rate, plus a little variable operations and maintenance. Wind and solar, they sit near zero variable cost. Nuclear is also low, but super inflexible. Then you have gas and coal sitting a bit higher, shifting around with fuel prices. And finally, your oil or gas peakers way up at the top. The system essentially takes all this available generation and stacks it up sequentially,
from the absolute cheapest right up to the most expensive, until that cumulative capacity perfectly meets consumer demand. This specific sequential ordering, that's what we call the merit order. On a real, functioning trading desk, understanding this is literally a rule of survival. There's a saying, traders who read the stack anticipate price moves, traders who only watch the screen react to them. Almost every price you trade in a power market is, at its core, the outcome of a dispatch decision. If you really understand the merit order, you know exactly which fuel is on the market right now, and you know exactly how much headroom you have before a more expensive unit gets pulled in. It lets you anticipate where a tiny move in demand or a sudden plant trip will make the price violently lurch, rather than just staring blankly at flashing red numbers on your screen. Which brings us to Section 3, Marginal Unit Sets Price. Let's look at a simplified 5-generator system to see how this works. Step 1 is ordering these units by their variable cost. We start with wind at $0 per megawatt hour. Next in line is nuclear at $8, coal at $32, combined cycle gas turbines, or CCGT, at $48, and finally, sitting at the top, our very expensive peaker plant at $95 per megawatt hour. That right there is our supply stack. Now, let's see what happens when we introduce actual consumer demand. Say we have a perfectly normal system demand of 3,200 megawatts. We just stack these units from left to right until we hit that target. So 600 megawatts of wind, plus 1,000 of nuclear, plus 800 of coal. That gets us to 2,400 megawatts. We still need 800 to hit our 3,200 megawatt demand, right? Well, the CCGT unit has 900 megawatts of capacity, so it easily covers that remaining 800. Our demand lands squarely on that CCGT step. And here's the kicker. Because the CCGT is the last unit needed to meet our demand, it becomes our marginal unit. In a market that clears at marginal cost, the price for all dispatched energy is simply the variable cost of that final unit. So boom, it sets the clearing price for the entire market at $48 per megawatt hour. Now, you might be wondering, what about all those cheaper generators to the left? Those are inframarginal units. They are dispatched, they're running, and they are printing money. They get to happily earn the difference between that $48 market clearing price and their own internal variable costs. So our coal unit, costing $32 to run, is pocketing a margin of $16 per megawatt hour. The CCGT is basically breaking even on the margin, and that $95 peaker, it's what we call out of merit, meaning it's way too expensive to be dispatched today. All right, Section 4, Why Power Prices Jump. We all know power markets are notorious for extreme face-ripping volatility. But why? Let's stress test our system. Imagine demand ticks up slightly, moving from 3,200 megawatts to 3,350 megawatts. That's just a modest 5% increase. What does that do to our clearing price? This brilliantly illustrates the exact discontinuity that constantly catches junior traders off guard. At 3,350 megawatts, we completely exhaust that remaining 100 megawatts of the $48 CCGT. To meet that final 50 megawatts of demand, the system is literally forced to pull the $95 peaker plant into the mix. The peaker is the new marginal unit, and the price instantly snaps from $48 to $95. Think about that. A mere 5% move in demand just doubled the price of power across the entire market. So here is the absolutely crucial takeaway. The supply stack is a lumpy step function. It is not some smooth, continuous textbook curve. This step structure is the absolute root cause of short-term price volatility in power markets. It is the single most important intuition you can build today. Tiny demand changes or dropping a little bit of cheap renewable generation can trigger massive, violent price moves simply because of the sheer cost gaps between these steps. Section 5, Trading Desk Reality Check. Now, let's talk reality, because as a practitioner, you absolutely have to practice model skepticism. That clean 5-unit stack we just walked through, that's a teaching device. A real merit order has thousands of units, and it's shifting continuously every few minutes as fuel prices move and plants randomly trip offline. Plus, our simple model ignores the messy stuff. Real dispatch is bottlenecked by physical transmission limits and strict unit commitment rules like minimum run times. Oh, and you definitely can't always assume generators bid their true variable cost. Scarcity adders and strategic market behavior can push clearing prices way above a simple merit order calculation. When a massive thermal unit trips offline unexpectedly, a seasoned power trader doesn't just ask, "How many megawatts did we lose?" No. Their very first thought is, okay, which fuel is on the margin now? That physical lurch up the stack is exactly what feeds straight into your enterprise ETRM systems. The ETRM doesn't calculate the dispatch itself, but it consumes those dispatch-driven prices through market data feeds. Understanding merit order pricing is exactly how a good desk explains precisely why the forward curve just gapped up and why the book's value at risk is suddenly flashing red the morning after a major plant outage. And this conceptual core is going to directly power your Module 1 project. You'll be building a dispatch simulator from scratch. The logic is actually quite elegant. Sort the generators by variable cost ascending, compute your cumulative capacity, find the first unit that meets or exceeds your demand, and return that unit's cost as your clearing price. By building this out in code and feeding it variable demand and renewable output, you're going to programmatically reproduce the exact same violent price jump behavior we just saw. As we wrap up this explainer, I want to leave you with a classic desk interview question. Why does a 5% increase in demand sometimes double the clearing price, while other times it barely moves it at all? Well, by now you know the answer. It depends entirely on the cost gap to the next unit in that lumpy step function. Sometimes you're sitting on hundreds of megawatts of cheap coal headroom. Other times you are teetering right on the edge of a $95 peaker. Think on that. I'll see you in Chapter 8, where we are going to complicate this whole picture by introducing unit commitment economics.
Welcome back to the Power Trading Desk Master Program. I'm your host, bringing you decades of desk experience from Durga Analytics. You know the drill by now. This program is our sequenced journey across 13 modules and 234 chapters, taking you all the way from grid physics right through to strategy, risk, execution, and ETRM architecture. Today, we're diving into a crucial explainer from Module 1, Chapter 8, Unit Commitment. We are basically going to take that perfect, frictionless merit order stack we built back in Chapter 7 and totally shatter it, replacing it with the gritty, money-making reality of an actual trading desk.
So let's kick things off with a classic desk mystery, one that consistently trips up junior analysts. Why on earth do we sometimes look at the market overnight and see thermal plants running full tilt, generating power when the market price is literally below their fuel cost? I mean, why would any rational commercial entity intentionally produce a product at a guaranteed loss?
Well, here's how we're going to solve it. First, we'll look at what lies beyond the simple merit order, then map out the core difference between dispatch and unit commitment. We'll look at the brutal cost of cycling, finally solve that midnight loss mystery, and wrap up with what this means for your daily desk insights. Let's get into it.
Okay, Section 1, Beyond the Merit Order, Breaking Chapter 7's Perfect Stack. To really get this, we've got to look back at that clean merit order from Chapter 7 and realize exactly why it completely falls apart in the real world. Academic textbooks? They assume units just magically fire up instantly for free. Snap your fingers, boom, you've got megawatts on the grid. But out on the desk, managing actual physical assets, we know that starting up massive coal or gas units takes hours, and it takes serious cash. You literally cannot just wish them online.
Which leads us directly to Section 2, Dispatch versus Unit Commitment, the core difference.
This right here is the fundamental distinction you have to master if you want to trade, model, or manage risk effectively. Dispatch versus commitment. Dispatch, that's just tweaking the dial. It's deciding exactly how much juice an already running unit is going to push out right this second. Commitment, though, that's the heavy lifting.
Unit commitment is the decision of whether to turn that massive plant on or off in the very first place. Because starting a thermal unit is a huge physical event, commitment is a forward-looking, multi-hour decision usually planned a full day ahead. You spend the money to commit a unit now because you expect you're going to need it later.
Moving right along to Section 3, the costs of cycling, physical constraints.
Let's look at the hard physical realities that make these commitment decisions so incredibly costly and, frankly, sticky for operations. A power plant is definitely not a light switch. You've got massive startup costs, burning fuel just to heat the boiler. You've got minimum run times. Once it's on, physics dictate it has to stay on for a set number of hours. You've got minimum downtimes, meaning once it's off, it legally and safely has to stay off to cool down before a restart. And then ramp rates, dictating how fast the output can actually dial up or down. All these constraints, they turn unit commitment into this massive combinatorial optimization problem for the grid.
And to really ground this financially, for your P&L, firing up a cold coal unit is incredibly expensive. We're talking about a startup cost that can easily hit 40 grand or way more, just in fuel and thermal wear and tear. That's $40,000 out the door before you've sold a single profitable megawatt.
So, Section 4, the Midnight Loss Mystery, solved.
And that $40,000 price tag is exactly what solves our initial mystery. Look at the chart here. You see that blue line? That's the market price tanking overnight. And that dashed orange line is our coal unit's variable cost, say $35 a megawatt hour. The price drops down to around $10, well below cost, right? But the solid block at the bottom shows the unit running straight through all day and night. The plant is riding out that cheap off-peak valley, bleeding cash simply because it's already committed for tomorrow's peak.
Let's actually run the numbers, because this is how you survive on the desk. See overnight prices drop to $28, meaning you're losing $7 on every megawatt hour. Option A, you shut down. You lose $0 overnight, but you eat a $40,000 restart fee tomorrow morning for the peak. Option B, you ride it out through the night. You take a $7 loss for 8 hours on a 500 megawatt plant. That's a $28,000 total loss. Do the math. Eating a $28,000 hit overnight is mathematically superior to paying that $40,000 restart fee. It's a no-brainer.
A novice trader sees that generation happening below cost and instantly thinks, oh, the market's broken, it's an irrational error. But a veteran trader and a properly tuned ETRM system sees perfectly rational commitment economics at work. Basically, it's cheaper to bleed a little bit at night than to completely hemorrhage cash in the morning.
All right, Section 5, Desk Insights and Reality, Trading and ETRM.
So how do we apply this directly to your trading strategy and valuation models? Here is your core desk insight for today. When off-peak prices are acting weird and units are generating at an apparent loss, do not assume the market is broken. Your professional instinct should always be commitment. Those units are anchored down for the upcoming peak, riding out the cheap hours because cycling off and on is just way too expensive.
In the enterprise reality, independent system operators, the ISOs, are running these massive production-grade mixed integer optimization engines to figure out these commitments. As a trader, you literally never see that solver. You only see the resulting market prices. You have to reverse engineer their commitment decisions. If your desk analytics or your ETRM system only models simple dispatch, you are going to systematically misprice the off-peak. And honestly, you will lose money.
Finally, Section 6, Key Takeaways.
Let's lock these rules in before we wrap up. Remember the absolute basics. Commitment dictates who is on, while dispatch just decides how much. Commitment is always a forward-looking, multi-hour puzzle driven by incredibly sticky physical constraints like minimum run times and massive startup fees. And most importantly for your P&L, real-world commitment economics are the exact reason why a simple textbook merit order completely fails to explain what's actually happening with off-peak prices.
So, now that you grasp the sticky costs of unit commitment,
Think about this. How do we model these plant constraints when the grid's physical transmission lines actually start maxing out and congesting? Well, that is a deeper puzzle we'll solve in Chapter 11 with Security Constrained Unit Commitment, or SCUC. But before we get there, we need to understand how to optimize the units that are already running. So join me in our next explainer for Chapter 9, where we tackle economic dispatch. Until then, keep your model sharp and trust the physics of the grid.
Welcome back to the Power Trading Desk Master Program. I'm your consultant from Durga Analytics, and we're continuing our sequenced journey across 13 modules and 234 chapters. Our goal here is to translate the physical reality of the power grid into real trading strategy, risk management, and ETRM technology. Ultimately, we are here to help you design a durable trading organization that actually makes money and, just as importantly, survives. Let's get right into it. We are currently making our way through Module 1, Power System Fundamentals. Now, in Chapters 7 and 8, we covered merit order dispatch and unit commitment. Today, we're diving into Chapter 9, Economic Dispatch. This is it. This is the exact mechanism that forms the real-time physical price, literally second by second. Understanding this completes your picture of how the market actually values electricity right in the moment. Here's our roadmap for this explainer: context and dispatch basics, dispatch versus unit commitment, the equal marginal cost principle, real-time price volatility, common desk trading pitfalls, and finally, takeaways and next steps. Let's just jump right in. Section 1. Context and dispatch basics. Squeezing the lowest cost from the grid. So, what exactly is economic dispatch? At its core, it's the continuous process of choosing the output for units that are already running to meet demand at the lowest possible total variable cost, while of course respecting their physical minimum and maximum limits. That phrase, already running, is absolutely crucial here. Once the system operator has committed certain units to be turned on, they have to decide, moment to moment, exactly how much juice each specific unit needs to produce to squeeze out the lowest possible cost. This isn't some slow daily process. It is the real-time engine firing every few minutes as demand and grid conditions inevitably shift around. Section 2. Dispatch versus unit commitment, the ultimate interview trap. You know, this is a very common modeling error and honestly a classic interview trap for junior analysts and traders. If you confuse these two concepts, it basically signals to the desk that you don't grasp the underlying market mechanics. Here's the deal. Unit commitment is the slow, forward-looking, binary on or off decision. It decides which units are running. Economic dispatch, on the flip side, is the incredibly fast, continuous how much decision. Dispatch does not turn plants on or off at all. It simply throttles the output of the units that are already online. These are entirely different decisions, playing out on entirely different timescales. Section 3. The equal marginal cost principle, the math behind the clearing price. Let's unpack the core mathematical theory driving this dispatch algorithm. At the least cost solution, all dispatchable units that are partly loaded, meaning they aren't completely pegged at their absolute minimum or maximum output limits, will have the exact same marginal cost. Think about it intuitively for a second. If one unit's marginal cost was even slightly lower than another's, the grid operator would simply shift the output toward the cheaper unit to save some cash, right? You only stop shifting that output when the marginal costs perfectly equalize. And that common marginal cost where everything balances out, that is your clearing price. Let's run through a quick, real-world example with upward-sloping marginal costs. Say we have two committed units serving 900 megawatts of demand, each with their own cost formulas and base outputs. For the quants and analysts building models on the desk, the massive takeaway here is that dispatch isn't just about filling the cheapest unit first. It's a delicate algebraic balancing act. To hit exactly 900 megawatts at the absolute lowest cost, the algorithm balances both units until their costs meet. If you run the math, Unit X takes 460 megawatts, Unit Y takes 440 megawatts, and they perfectly equalize at a marginal cost of exactly $35.20. Neither unit could be made any cheaper. Constant marginal cost clearing is just a special case, but this is how real dispatch works. And that value, where they meet, that $35.20 in our example, is represented by a single, elegant number, lambda. At the dispatch optimum, all partly loaded units share this common marginal cost. In an unconstrained system, lambda perfectly dictates the system clearing price. It is literally the cost of meeting the very next megawatt of demand anywhere it can be met on the grid. Moving to Section 4, Real-Time Price Volatility, Measuring Instantaneous System Stress. Let's take this from mathematical concept right down to the trading desk reality. The thing is, demand never, ever holds still. Renewables fluctuate constantly with the wind and the sun, and frankly, sometimes units just trip offline unexpectedly. Because of all this chaos, the dispatch algorithm has to resolve continuously. Plant outputs are constantly getting nudged up and down to keep the entire system perfectly balanced at the least possible cost. The real-time price is simply the financial output of this relentless, continuous physical optimization loop. And this dynamic updating is exactly why real-time prices are incredibly volatile compared to day-ahead prices. They are the heartbeat of instantaneous grid stress. On the desk, you'll see traders watching the real-time price like a hawk, because it's the truest read on that system's stress. There's a great desk insight that says a real-time price diverging sharply from the day-ahead price tells traders that the system is tighter or looser than yesterday's forecast expected. And that is very often the first sign of a developing market move. Veteran traders read these high-frequency, diverging price signals as physical grid realities that translate directly into massive financial opportunities, or conversely, massive risks. Section 5. Common Desk Trading Pitfalls, where theory meets desk reality. From an enterprise perspective, what actually blows up desks when they try to model this stuff? Well, a few major pitfalls stand out. First, over-trusting the day-ahead price as the definitive price. As we just saw, real-time dispatch will diverge, and often sharply. Second, assuming flat marginal costs. The reality is many units have rising marginal costs, which is exactly why understanding the equal marginal cost principle is so vital for your desk models. Third, ignoring how these high-frequency price signals drive intraday risk. The sheer, raw volatility of this signal is the precise reason intraday risk management even exists as a discipline for survivors. We'll actually cover that deeply in Module 7. And finally, failing to feed this volatility into your real-time ETRM pricing engines. That's a huge operational risk, and it's a major focus for us later in Module 11. Section 6. Takeaways and next steps, wrapping up the frictionless model. All right, let's bring it all home. What do you need to internalize for your desk? Number 1, economic dispatch optimizes output for units that are already committed to meet demand at the absolute lowest cost. Number 2, at the optimum, those partly loaded units will share a common marginal cost, lambda, and that forms your clearing price. Number 3, this continuous, relentless resolving engine is what produces the highly volatile real-time price. And finally, for your traders, that price is invaluable because it tracks instantaneous system stress, giving you a real-time signal for market tightness. Now, we have been working with a frictionless system so far today, but what happens to this elegant, equal marginal cost equation and our beautiful single clearing price lambda when the physical grid suddenly hits a transmission bottleneck? Because out in the real world, dispatch has to contend with ramp limits and nasty network constraints. And well, that changes absolutely everything. That's exactly what we're going to explore in Chapter 10 when we introduce Security-Constrained Economic Dispatch, or SCED. I'll see you there.
Hey everyone, welcome back to this explainer from Durga Analytics. I'm your host, your power trading and risk management consultant. Today we're doing something, well, absolutely crucial. We are literally translating the physical, humming reality of the power grid into the exact financial basis risk that you trade on the desk. We're talking about SCED, Security Constrained Economic Dispatch. Look, if you want to survive and actually make money on a power desk, understanding how a physical wire limit turns into a financial opportunity, that is absolutely non-negotiable.
Just to ground us real quick, as a reminder, we're working our way through our comprehensive Power Trading Desk Master Program. That's a sequence journey spanning 13 modules and 234 chapters, taking us from grid physics all the way up to enterprise ETRM and organizational design. Right now, we're still squarely in Module 1, charting out the power system fundamentals. We are taking the simple, unconstrained economics we hammered out in Chapter 9 and dropping them straight into the locational reality of Chapter 10. And trust me, this sets us up perfectly for Chapter 11.
All right, let's fly through today's agenda. We've got 5 parts. 1. The security constraint problem itself. 2. How SCED drives locational prices. 3. A classic north-south worked example to make it real. 4. Deconstructing the LMP. And finally, number 5. Those critical desk insights and pitfalls you need to watch out for. Let's dive in.
Section 1. The Security Constraint Problem. Okay, so you know that clean, beautifully mathematical dispatch model you learned back in Chapter 9? Well, actually scratch that, it has a fatal flaw. It completely ignores the physical limits of the actual transmission grid. The network can only carry so much power on any given line before things start melting. SCED is the engine that actually respects the grid. If you just ran a purely unconstrained dispatch, you'd end up pushing way more power across certain lines than they could physically handle. It's technically infeasible, and honestly, running it risks cascading blackouts across the whole system. So security in this context means staying within these physical limits, even when you factor in credible contingencies, like say a major line tripping offline unexpectedly. The mandate is super clear: meet the demand at the absolute lowest cost, but you have to honor the transmission limits under both normal and contingency states.
Thinking about these two models side by side really highlights the reality check here. When there are no transmission limits binding, both models give you the exact same answer, just one single happy system price. But the very second a line hits its maximum capacity, boom, everything changes. SCED jumps in and forces the system operator to back off that super cheap generation that's overloading the line. Instead, they have to turn on much more expensive local units to serve the load right there behind the constraint. So the cheapest feasible dispatch just got a whole lot more expensive. And the crucial takeaway here, the price now differs by location.
Moving on to Section 2. Let's look at a north-south worked example.
Let's walk through exactly how a physical, structural engineering limit transforms into a financial price that you can actually trade. Picture this scenario. We've got cheap generation sitting up in the north, cranking out power at $25 a megawatt hour, and our load is sitting down in the south. They're connected by a single line, and that line has a strict hard limit of 500 megawatts. Now, in our fantasy unconstrained model, the south would just import all 700 megawatts of that cheap northern power, right? But reality bites. The line caps those imports at 500, period. To keep the lights on, SCED is forced to serve that remaining 200 megawatts of demand by firing up an expensive southern generator costing $70 a megawatt hour. So now, the South's marginal cost reflects that pricey local unit, while the North's reflects the cheap one. And the result of all that? You get a $45 per megawatt hour spread. The line is officially congested, and the prices diverge by the exact cost gap between that expensive local unit and the cheap remote one. That $45 spread is literally your congestion cost. And here's why you should care. A trader holding a south minus north basis position, they are long exactly this congestion. SCED is the exact mechanism that turns a physical line limit into the very price spread flashing on your trading screens.
All right, Section 3, Deconstructing the LMP.
So SCED isn't just some theoretical whiteboard math. It's the fundamental underlying engine producing the locational marginal prices, or LMPs, that you're staring at all day long. Let's break that LMP down. At any given node, an LMP is made up of 3 parts: the system-wide energy price,
a congestion component, and a loss component. Notice anything? SCED directly outputs those first two, energy and congestion. That right there is your raw material for FTR, or financial transmission right, valuation, basis trading, and managing your congestion risk. Honestly, if you don't understand SCED, you really have no idea where your congestion revenue or your basis risk is actually coming from.
Which brings us to a critical definition. Serving just 1 extra megawatt behind a constraint means we have to rely on that expensive local generation, right? This means the congestion component of the LMP is simply the shadow price of that binding limit, mathematically mapped to that specific location. Think of it this way. Every single time you see a congestion price, you are literally looking at the financial shadow of a physical grid limitation.
Let's hit section 4, desk insights and pitfalls.
Because understanding the math is really only half the battle. We need to know how this plays out operationally on the desk and where the models blow up. I want to hammer this point home for you. When a desk sees a note's price suddenly detached from the broader system price, your first instinct should absolutely not be, oh, it's just data noise or a glitch in the ETRM. No way. Your immediate question has to be, okay, which specific constraint is binding right now? Congestion is almost never random. It's a specific line maxing out, and knowing which one tells you if that spread is going to hold or if it's about to collapse.
You've got to maintain a healthy dose of model skepticism on the desk. Here are the traps I see people fall into all the time. First, ignoring contingencies. Remember, system security isn't just about normal state limits. It actively prices in credible failures, which tightens your constraints even further. Second, assuming there's still just one system price. Guys, once a constraint binds, the single price is gone. Done. It splits. And finally, blindly trusting the market model's DC approximation. Look, market LMPs are simplified. They leave out messy realities like voltage drops and reactive power. That means that grid operators' true constraints might actually look a bit different from what your market model is telling you.
So let's test this with a classic desk interview question. What is the relationship between a binding transmission constraint and the price difference between two locations? If you get asked this, a weak answer kind of just waves its hands vaguely at supply and demand. But a strong answer, a professional answer, identifies that the resulting price difference is exactly equal to the congestion component, which is the shadow price of that specific binding transmission constraint. If you treat congestion as random noise instead of a structural, identifiable shadow price, well, that's a fatal flaw if you want to make it as a power analyst.
Let's wrap this up with your key takeaways. To summarize, SCED is the crucial bridge connecting the physics of the grid with the finance of the desk. It is least cost economic dispatch, but strictly bound by physical limits. When a line binds, it forces expensive local generation to turn on, driving up the marginal cost behind that constraint. That process turns physical limits into the exact congestion basis risk you trade every day, directly outputting the energy and congestion components of your nodal LMPs.
Now that we've mastered how SCED manages this minute-by-minute dispatch, it's time to zoom out a bit. How does the grid plan for tomorrow? How do they decide which of those big, slow-starting power plants need to be fired up in advance just to ensure these constraints are met in the first place? Join me in the next explainer for Chapter 11, Security Constrained Unit Commitment. Until then, I want you to ask yourself, what hidden physical bottlenecks on your grid are secretly driving your desk space's risks today, and are you actually positioned to profit from them?
Welcome back to another Durga Analytics Explainer. I'm your host, and as someone who has spent decades building power trading desks and risk systems, I can tell you today's topic is absolutely fundamental. We are stripping down the core engine that actually drives day-ahead power prices, Security-Constrained Unit Commitment, or SCUC. So let's dive right in with a classic trading desk mystery. You know, if you've ever stared at your screen, scratching your head and wondering why day-ahead power prices are literally blowing up during a quiet afternoon shoulder hour when demand is actually really low, well, you are definitely not alone. It's a total trap for rookie traders. And the answer to that exact question lies entirely in the complex math we're going to unpack right now. Now, for some quick context on our 234-chapter Power Trading Desk Master Program, we are currently deep in Module 1. We're fusing the binary on-off decisions we covered in Chapter 8's Unit Commitment with the network limits from Chapter 10's SCED to master Chapter 11, which is SCUC. Mastering this fusion? Yeah, it's non-negotiable for understanding market structure. Okay, Part 1, the day-ahead clearing engine. Let's look at what SCUC actually is in the real world of power markets. SCUC isn't just some simple spreadsheet calculation. It's an incredibly massive mixed integer optimization algorithm. The ISO runs this beast to marry binary on-off commitment decisions with continuous dispatch variables and thousands, literally thousands of network security constraints. It solves this over every single hour of the next day, across the entire network. Honestly, it is the most computationally demanding routine an ISO runs. And here is the so what for you on the desk. When you pull up day-ahead prices on your terminal, you aren't just looking at a simple supply stack. You're looking directly at SQCU's marginal prices. This algorithm chooses the schedule to meet tomorrow's forecast demand at the absolute least total cost, which essentially dictates exactly what physical operations must deliver the following day. Moving into Part 2, the shoulder hour price anomaly. Let's take this theoretical engine and apply it to a hands-on trading desk scenario to solve our initial mystery.
Imagine this. The SCCU algorithm sees a massive demand peak coming at 6 p.m. To hit that peak, it realizes it absolutely needs an expensive peaker plant. But that plant takes 4 hours to start up. So what happens? SCUC has no choice but to commit that unit early, at 2 p.m., pulling those massive startup costs forward into the quiet afternoon hours. The 2 p.m. demand doesn't strictly need it, but the math forces the unit on anyway, and bam, your 2 p.m. day-ahead prices spike.
This dynamic right here is exactly what separates the rookies from the pros. A junior trader modeling a simple merit order stack, just lining up cheap to expensive generators for that specific hour, is going to drastically underpredict those afternoon prices and just get run over by the market. But a pro sees how future peak commitments distort present prices because failing to serve that 6 p.m. peak is mathematically far costlier. Which brings us to Part 3, SUCC on the desk. Understanding this NP-hard mathematical reality is quite literally what separates desks that consistently make money from the ones that eventually blow up. It all comes down to market timing. Day-ahead positions always settle against SCU prices, which includes those messy, multi-hour commitment decisions. But real-time prices, they clear using an entirely different engine called SCED, or Security-Constrained Economic Dispatch, which just optimizes for the current moment without the full look ahead. This structural divergence between these two engines is exactly what advanced desks target with virtual bidding, a strategy we're going to dive into deeply in Module 3. I really love this quote because it captures the exact insight you need to survive. When day-ahead prices don't match your desk's fundamental stock, your instinct shouldn't be to yell that the market is wrong. Actually, scratch that. Your very first instinct must be to ask, what future peak is SUC preparing for right now? Peak commitments consistently pull cost into earlier hours in ways a naive stack completely misses. From an enterprise perspective, if you're trading fundamental power, you have to play the exact same game the ISO plays. Replicating the ISO's SUKSU engine requires production-grade mixed integer linear programming, or MILP solvers. We're talking heavy-duty data engineering here. It is exactly why serious fundamental desks rely on the robust analytics and ETRM tools we'll be building out later in Modules 6 and 11. Finally, Part 4, Model Skepticism. Whether you're managing risk on a live desk or sitting in a high-stakes interview for a quant role, you need to know where these models break. A really common interview mistake,
and frankly a fatal trading flaw, is assuming a day-ahead price is just a true stack snapshot. Never underestimate the scale here. SCUC is an NP-hard problem solved under incredibly tight time limits, meaning the ISO actually accepts a near-optimal solution. Those day-ahead prices embed specific solver tolerances. They're in some perfect platonic ideal. And if you ignore the tradable divergence between SCUC and SCED, you are just leaving money on the table. So, to wrap this all up, SCUC and SCED are your two core optimization engines operating behind the scenes. SCUC combines unit commitment with network security over the whole next day to produce your day-ahead LMPs. And because it's a massive mixed integer program, its forward-looking peak commitments will definitely distort those shoulder hour prices. Mastering these mathematical quirks isn't just theory, it is your absolute fundamental trading edge. Next up is Module 1, Chapter 12, Transmission Topology. We've stripped down the engine, clearing the market, but what happens when this beautiful, elegant mathematical optimization slams right into the harsh physical bottlenecks of the real-world grid? Can the math actually survive the physics? We'll find out next time. Welcome back to the Durga Analytics Master Program. I'm your host, and as a consultant who spent decades running power desks and designing ETRM systems, I am thrilled to dive into this explainer with you. Our program is a massive, carefully sequenced journey, 13 modules, 234 chapters. We covered the whole shebang, from the nitty-gritty physics of the grid and market reality, right through to trading strategy, risk management, execution, and building a durable trading organization. Today, we're getting our hands dirty with the true physical realities of the grid in Module 1, Chapter 12, Transmission Topology. So right now, we are deep into Module 1, laying the absolute physical groundwork before we even touch the advanced strategies in ETRM tech coming up later. Every chapter we do is built around real markets, real numbers, and a desk-ready project. Chapter 12 here is a crucial 101 level concept that builds directly on our very first chapter, why the physical system actually drives the price. Look, if you want to make it on the desk, here is your golden rule. Every single locational price difference you'll ever trade stems entirely from the physical layout of the network. It's not just some abstract financial model, right? It's literally about what wire connects to what and exactly where the bottlenecks are. Grasping this is absolutely foundational for trading congestion, basis, or financial transmission rights. Let's take a really quick look at our agenda. First, we'll cover the grid's physical vocabulary. Second, we'll contrast physics with contract paths. Third, predicting topology and congestion. And finally, desk realities and common pitfalls. Let's get to it. Okay, Section 1, the grid's physical vocabulary. If you're going to survive on a power desk, you've got to speak the language of the grid like a native. At its core, the grid is just a giant network. At the base level, we have a node, or a bus. Think of it simply as a connection point where generation, load, or lines hook up. And here's the kicker for us as traders. This is exactly where locational marginal prices, or LMPs, are defined. Power gets injected at one node, withdrawn at another, and flows across the whole system. Now, joining these nodes together, we have lines. But a line is definitely not some boundless infinite highway, not at all. Every single line has strict physical, thermal, or stability limits. Basically, these limits act as a hard, unbreakable ceiling on exactly how much power can flow through them at any given microsecond. Moving up a level, we have what's called an interface. An interface is simply a group of lines between different areas that grid operators often manage together as a single, combined constraint. Knowing your interfaces inside and out is key to spotting regional grid limitations before the rest of the market does. Finally, you'll see markets frequently roll up these individual nodes into larger zones or hubs. They do this mostly for trading liquidity and settlement purposes. But please remember this core principle. Even though markets aggregate nodes into these big financial zones, the underlying physics of the grid remains entirely 100% nodal. All right, Section 2, Physics versus Contract Paths. This right here is the crucial paradigm shift that makes power trading so wildly unique compared to other commodities. How you buy power financially is completely decoupled from how it physically behaves. Your financial contract might explicitly say, hey, I'm trading power from point A to point B, but electricity, it doesn't care about your contract. It doesn't travel down a designated A to B wire. Instead, physical power distributes itself across all available paths on the network based purely on the laws of physics, specifically impedance. This creates what we call loop flows, surging through completely unrelated regions. Your contract is financial, but the physical flow always follows the network. Moving on to Section 3, Predicting Topology and Congestion. So let's see how this decoupling actually creates predictable congestion. Take a look at this 5-node network. Let's say cheap generation at node A wants to serve a load over at node C. You might intuitively think, oh, the power just goes A to B to C, right? Wrong. Physically, dictated by line impedances, the power splits. Sure, some goes across the top path, A to B to C, but a chunk of it also flows across the bottom path, A to D, to E, and then to C. Now imagine the line down at the bottom, from D to E, hits its physical limit. It can't take any more juice. It becomes a binding constraint. It's congested. Even though your trade was nominally just A to C, this congested D to E line forces the prices at node C to diverge sharply from node A. Boom, you've got a congestion spread. And it's driven entirely by the topology of the grid, not your piece of paper. Which brings us to Section 4, Desk Realities and Common Pitfalls. Look, textbook theory is great, but it only gets you so far on the trading floor. Decades on the desk taught me that these topological bottlenecks, they're largely predictable. The best traders carry a mental map of their grid's recurring constraints. They know, for instance, that a specific interface binds every single summer. So when a heat wave pops up in the forecast, they aren't waiting for the congestion to flash on the screen. No way. They position for that A to C spread widening well in advance because grid topology makes congestion repeatable. And from an enterprise tech perspective, you can't just manage the financial prices. You literally have to manage the physical reality. Network topology and line limits are the foundational reference data underpinning any credible nodal price or FTR model. If your desk is out there trading congestion, your ETRM system has to accurately represent this actual physical network. Honestly, that's exactly why our Module 3 project mandates that you build an explicit node and line model to compute LMPs. But hey, time for a quick reality check. While our little 5-node diagram earlier was perfectly tidy, real grids have thousands of nodes. They have massive loop flows that completely defy basic intuition. And crucially, topology is not static. It's moving constantly with routine switching and unexpected plant outages. The constraint that bound last Tuesday, it might completely vanish today. You have to stay hypervigilant. So, as you're building your models and laying out your desk strategies, please do not fall prey to these incredibly common analytical mistakes. Do not assume your physical flow matches your contract path. Do not ignore those tricky loop flows because trades absolutely affect congestion in areas that look totally unrelated on a map. And never ever treat financial zones as physical realities. They are just aggregations. The actual physics is strictly nodal. Let's wrap this up with a classic interview question, one that catches out a ton of aspiring analysts. If you sell power from Zone A to Zone C, does the electricity travel directly from A to C? The answer, as we've hammered home today, is absolutely not. Assuming power flows neatly along the contracted path is a total rookie mistake. It flows by physics across all paths as loop flow. That means your simple A to C trade can and will congest a seemingly random line hundreds of miles away. Ultimately, topology is the physical origin of every basis trade and locational price difference you are ever going to encounter. So keep this mental map of nodes, lines, and loop flows firmly lodged in your brain. But I'll leave you with this. If electricity always takes the path of least resistance across the grid, are your trading models doing the same, or are they built on pure financial fiction? Something to chew on as we transition to Chapter 13, where we'll dive into the fascinating differences between AC versus DC power flow. I'll see you in the next explainer.
Welcome to this explainer. I'm your power trading and risk management consultant from Durga Analytics, and today we're tackling Module 1, Chapter 13 of the Power Trading Desk Master Program, AC versus DC Power Flow. Look, if you want to understand the actual hidden mechanics behind those prices flashing on your trading screens right now, you are in exactly the right place. Let's get into it.
But real quick, before we jump into the physics, let's remember exactly where we sit in the wider program. This course is a sequenced end-to-end journey across 13 modules and 234 chapters. We're covering the whole shebang, from the physical grid and market design, right through instruments, strategy, valuation, and risk, all the way to execution, ETRM technology, and governments. Why do we do it this way? Because surviving and actually staying profitable on a modern power desk requires you to understand the entire machine, not just one isolated moving part. Today, we're zooming in on a really critical piece of Module 1.
Okay, let's dive into this. Here's our roadmap for Chapter 13. We'll hit the course intro, the AC physics versus the DC model, why markets use DC, the market blind spots, the real-world desk impact, and finally, our takeaways in next chapter.
Section 1. Course Intro. Let's start with the central tension of this entire chapter, which is basically what the market model thinks is happening versus what's actually happening out there on the grid. Here's the hook, and it's something every single aspiring and working power trader absolutely needs to internalize. The locational marginal prices, those LMPs you trade on every single day, they're generated by a simplified illusion. The market models producing those prices intentionally ignore certain physical realities of the grid. And honestly, understanding exactly what gets left on the cutting room floor, that is what separates the survivors from the casualties on a trading floor.
Section 2. AC physics versus DC model. So, to understand this market illusion, we've got to look at the grid's fundamental physics. On one side of the ring, we have full AC flow. This represents the true, beautifully messy physics of an alternating current grid. It involves real power, reactive power, voltages, and phase angles. And crucially, it is governed by highly complex, nonlinear equations. Solving this is non-negotiable for real-time operations and voltage stability. But on the other side, we have the DC approximation. This is what the market uses. It's a simplified, linearized model that only looks at real power. And this brilliantly illustrates the exact divide we're talking about. Over on the operations side, you have the robust reality of full AC flow, keeping the lights on and maintaining stability. But over on the market side, you have the DC approximation, churning out your LNPs. It's clean, it's incredibly fast, but it is completely blind to voltage and reactive power constraints.
Now, let's clear up a massive and, frankly, embarrassing common pitfall. I can't tell you how many people fail desk interviews over this exact thing. When we say DC approximation, we do not mean direct current. We aren't talking about giant batteries or high-voltage DC transmission lines here. DC in this context is purely a historical analogical term. It simply means a mathematical linear approximation of AC flow. So if you get asked this in an interview, please remember, it's a linearization, not literal direct current.
Section 3. Why markets use DC?
You might be wondering, if the DC model ignores so much of the physical reality, why on earth do ISOs and RTOs rely on it? Well, because linearity is the ultimate prize here. By making a few key simplifying assumptions, like assuming flat voltages, super small angle differences, and negligible line resistance, system operators can reduce nightmare nonlinear equations into fast linear ones. Security-constrained unit commitment and economic dispatch, those are massive optimization problems. If they tried to use full AC, the market computers would literally melt before they could produce tomorrow's prices. The math absolutely must be tractable to clear the market and spit out those clean LMPs on time.
Section 4.
the market blind spots.
But, as we all know, speed comes at a commercial cost. You have to know exactly what you're trading on. So the crucial point is this. The DC approximation perfectly captures real power flows, basic line limits, and the resulting energy and congestion prices. That is what you are seeing on your screen. But look closely at what it omits. Reactive power and voltage constraints are completely missing. Poof, gone. Now, system losses are also omitted from the core math, but they're usually slapped back on later as a separate LMP component. The reactive power and voltage, though, totally ignored by the base optimization.
For your standard, run-of-the-mill energy market congestion, this DC approximation is the industry standard, and honestly, it's good enough. But here is the kicker. It becomes downright dangerous in heavily loaded or weak parts of the grid where voltage issues dominate. In these stressed regions, very real operational constraints exist out there in the physical world, but they simply do not appear in the market's DC model.
Section 5. Real-world desk impact. Let's bring this theory directly down to the trading floor. How does this actually lose you money? Well, imagine this worked example. Step 1. The day-ahead market clears using the DC power flow. It sees absolutely no binding constraints on a specific corridor, so the prices it spits out are nice and uniform. Everything looks great. But in Step 2, the real-time operator is looking at the actual physical grid using their full AC analysis, and boom, they see a severe voltage limit looming. Step 3. To keep the grid from collapsing, that operator has to step in and manually redispatch generators out of market. And then Step 4. You, the trader, who built a massive position relying purely on those DC-based congestion signals, are completely blindsided. The market price didn't reflect the constraint because the model you were staring at was blind to voltage in the first place.
Now, what's really interesting about this is how it shapes desk behavior. Experienced congestion traders, they don't blindly trust their models. They know that the market's price model is just a DC approximation. So when they're looking at weak or voltage-prone regions, they know that operational reality and out-of-market redispatch can wildly differ from what the DC model predicts. They treat those clean-looking prices in those areas with a very healthy dose of professional suspicion.
Section 6. Takeaways in next chapter.
So let's summarize the strategic and enterprise consequences of this whole divergence. Full AC models, everything, but it's incredibly computationally heavy. Markets use the linear DC approximation to keep things fast and produce clean LMPs. Because of this trade-off, the market captures real power congestion but completely misses voltage and reactive power issues. From an enterprise perspective, say you're an analyst or a quant building a nodal price model for your desk, replicating market LMPs means you have to purposefully replicate the DC approximation, blind spots, and all. But if you are trying to predict actual system operator actions in real time, you need the richer physics. It's a massive data fidelity issue, and knowing which model to use when is absolutely crucial.
We've just unmasked the mathematical illusion behind market prices. But honestly, this leaves us with a pretty critical question. Now that we know how congestion is mathematically modeled and sometimes completely ignored, how do grid constraints physically bottleneck the network out there in the real world? Well, let's find out in our next session, Chapter 14, Transmission Constraints and Congestion. I'll see you there.
Welcome to This Explainer. I'm your consultant from Durga Analytics, and with a few decades on the desk under my belt, my goal today is to translate the physical reality of grid transmission limits into actionable, desk-ready financial concepts. Look, if you're aiming to build, run, or support a profitable power trading desk, understanding the actual physics of the grid is absolutely non-negotiable. So, today we're bridging the gap between how electrons physically move and how those movements create real, tangible financial opportunities.
Just as a quick reminder before we jump in, our overall Power Trading Desk Master Program is a sequenced journey. We're talking 13 modules and 234 chapters. We take you all the way from the fundamentals of the physical power system and market reality, straight through to strategy, valuation, risk management, execution,
ETRM control, and ultimately designing a durable trading organization. And every single module is built around real markets, real numbers, and desk-ready practices.
Right, so today we're diving into Module 1, Chapter 14. Here is our roadmap. We'll set the course context, define what grid congestion actually is, deconstruct locational prices, talk about trading the congestion spread, and then cover how to survive common desk pitfalls before wrapping up with some key takeaways.
Section 1. Let's ground ourselves in exactly where this chapter fits into your wider craft as a power trader, originator, or risk manager. I literally cannot overstate this. Congestion is where a huge amount of your power trading P&L lives. This chapter is the essential conceptual bridge from the physical constraints of the grid, which we covered earlier when we talked about security-constrained economic dispatch and topology, straight to the tradable spreads you're staring at on your screens every single day. Quite frankly, if you don't understand congestion, you just don't understand power basis.
Section 2. Defining grid congestion. We really need to understand the physical reality on the ground before we can attempt to trade it or manage its risk.
It is absolutely crucial for juniors on the desk to realize that congestion is not a system malfunction. It's just the normal mathematical consequence of a finite physical network meeting an economic dispatch that would otherwise overload it. You see, the system operator runs an algorithm to find the absolute cheapest way to power the grid. But sometimes, moving that cheap power from point A to point B would physically melt a transmission line. When that line hits its safe thermal limit, we say the constraint binds.
And when that constraint binds, the system is forced into what we call redispatch. Now, this is where the magic happens for traders. The grid operator has to back off the cheap generation on the constrained side, let's say a massive wind farm, and instead they have to turn on much more expensive generation, like a gas peaker plant, just to serve the load located directly behind that constraint. This immediately means the marginal cost of serving load differs by location. So one commodity, electricity, suddenly has vastly different prices at the exact same instant across the system.
Moving to Section 3, let's translate that physical constraint into the financial impact you actually see flashing red and green on your trading screens.
Let's visually deconstruct the locational marginal price, or LMP. Take a close look at how the congestion component wildly diverges between the hub, north, south, and export nodes. While the baseline energy component stays relatively flat across the board, that congestion component is what drives massive price differences. It's literally pulling the south node all the way up to $70 per megawatt hour.
Every locational marginal price decomposes into 3 specific parts: energy, congestion, and loss. By isolating the congestion component, which mathematically speaking is just the shadow price of those binding constraints mapped to a specific location, a trader knows exactly how much of a locational price is just the underlying system-wide energy cost versus a localized structural constraint. When nothing binds, the congestion component is 0. When constraints bind, prices diverge. It's that simple. Section 4. This brings us to the actual desk execution. How do we capture these locational price differences to generate returns?
Picture this worked example from the desk. Let's say northern wind is abundant and cheap, but the transmission line heading south is at its absolute thermal limit. So behind the constraint in the south, the marginal unit setting the price is an expensive gas plant at $70 a megawatt hour. Meanwhile, in front of the constraint in the north, it's cheap gas at $25. This physical congestion creates a massive $45 per megawatt hour spread. You can capture this if you're long a south minus north basis position.
This desk insight is brilliant because it fundamentally shifts how you need to think about trading power. Congestion spreads persist only as long as the underlying constraint keeps binding. You aren't just betting on a number going up or down in a vacuum. You're taking a calculated view on physical topology, weather patterns driving wind output, and unexpected line outages.
And from an ETRM and enterprise perspective, Tracking these congestion components explicitly isn't just a front office exercise. It feeds directly into your financial transmission right, or FTR, valuation, which we cover in Module 3. It defines distinct risk classes for your risk managers over in Module 7. And for the quants and middle office, it ensures accurate P&L attribution in Module 9. A robust ETRM system has to isolate congestion to tell you exactly why a desk made or lost money.
All right, Section 5. Surviving on the desk means avoiding the rookie mistakes that can absolutely blow up a trading book. Let's look at what typically takes down inexperienced traders. A huge pitfall is treating basis as random noise. A new trader looks at two nodes, sees a price spread, and thinks, oh, that's just random mean-reverting statistical arbitrage. Actually, scratch that. It is never random noise. In reality, it is structural congestion driven by stable physical topology and recurring weather or load patterns. If you try to model congestion as random noise, your risk models are going to be fundamentally flawed.
Another massive pitfall is completely ignoring topology changes. If a grid operator builds a new transmission line, or if a line goes down for maintenance and the constraint no longer binds, well, your beautiful $45 spread collapses to near zero instantly. That is the primary risk in these positions. Oh, and additionally, do not confuse congestion with losses. They are separate LMP components with completely different physical drivers. Losses are just a minor physics tax. Congestion is a major structural roadblock.
So, I want to test your readiness with a classic interview question. You'll often get asked this when hiring junior traders or quants. If two nodes 100 miles apart have vastly different prices at the exact same instant, what's the cause? The answer is structural congestion. And what instrument would you use to trade it? You'd use financial transmission rights, or FTRs. Nailed it?
Section 6. Let's wrap up this explainer with the key takeaways you need to bring to the desk tomorrow to sound like a seasoned professional. So the absolutely crucial point here is that basis trading is a bet on the physical reality of the grid. Congestion forces expensive redispatch, and that creates basis. The LMP's congestion component is simply the mathematical shadow price of that constraint. Because this is structural, you can trade it via FTRs. But never ever forget your ultimate risk. If the physical constraint is relieved, your spread collapses. Understanding this formula, that the locational price spread equals the difference in congestion components, is your fundamental edge in the market. And all of this brilliantly illustrates our next major challenge. If basis trading relies entirely on the precise physical nodes of the grid, what happens if a market operator decides to just average all those prices out into one big zone? Think about how that risk would impact your book. I'll leave you with that thought, and I will see you in Chapter 15, where we explore the massive strategic differences between nodal and zonal market design.
Welcome back to the Power Trading Desk Master Program. I'm your Durga Analytics instructor, and before we jump in, just a quick reminder about our overarching journey here. This program is a sequenced journey across 13 modules and 234 chapters. We're taking you from the physical power system and market reality right through trading strategy, valuation, analytics, and risk management. And then we go all the way to execution, ETRM technology, regulation, and the design of a durable trading organization, eventually culminating in a massive capstone project. So whether you're managing risk, scheduling physical flow, or architecting a multi-million-dollar trading system, the rules of the market completely dictate your reality. And today's explainer dives into a massive regulatory wedge that fundamentally changes how you trade. We're looking at how two totally different market designs handle the exact same physical grid congestion.
Here's our roadmap for this explainer. First, our place in the master program. Second, nodal versus zonal markets. Third, same physics, different prices. Fourth, managing hidden congestion costs. Fifth, life on the trading desk. And finally, number 6, pitfalls and key takeaways. Let's get to it.
All right, Section 1, Chapter 15 of the Master Program. So contextualizing exactly where we are right now, we are currently in Module 1, Power System Fundamentals, Chapter 15. We spent the last few chapters really unpacking the generation stacks and the nitty-gritty of AC versus DC power flow. Now, we are establishing the final foundational rules of how physical transmission constraints actually get priced. And this is absolutely crucial to grasp before we can move into actual trading strategies later on. Moving right along to Section 2, Nodal versus Zonal markets. Let's start with nodal markets. Think of U.S. markets like PJM or ERCOT. Here, locational marginal pricing, or LMP as we call it on the desk, is hypergranular. The system computes a totally separate price at every single injection and withdrawal node on the grid. So if there are thousands of nodes, you bet there are thousands of individual prices. The big takeaway for you here is that congestion is mathematically priced into the exact node where it's happening. The price perfectly and transparently reflects the local physics. But then, on the flip side, we have zonal markets. These are super common across Europe, places like Nord Pool or EPEX. Here, regulators basically group massive geographic areas into a single bidding zone. They compute one clearing price for that entire huge area. What this does is intentionally blur the reality of any internal grid bottlenecks. If there's a highly constrained transmission line buried deep inside that zone, you simply won't see it reflected in the wholesale energy price. So you can clearly see the distinct trade-off we're dealing with. Nodal design, that gives you absolute economic precision. Because congestion is explicitly priced, it creates these amazing first-class tradable instruments like financial transmission rights or FTRs. But yeah, that comes at the cost of immense mathematical complexity and sometimes really thin liquidity at any given single node. Zonal design, on the other hand, offers ultimate simplicity. You get this highly liquid, single price reference that makes basic hedging a breeze. But the trade-off is brutal. It sweeps the ugly reality of internal congestion completely under the rug. It relies on costly, opaque, out-of-market actions just to keep the grid stable. And honestly, as any veteran risk manager knows all too well, opaque costs will eventually eat your margins alive. Section 3. Same physics, different prices. To really get this into your bones, imagine a physical grid with really cheap generation humming away up north, incredibly expensive load down south, and a binding, maxed-out transmission line acting as a bottleneck between them. The physics of the electrons are identical in both scenarios. But in a U.S. nodal market, the system exposes that price difference across the individual nodes, reflecting the true locational value of that power. However, in an EU zonal market, the system just paints that entire area with a flat $40 price, basically pretending the bottleneck doesn't even exist, just for the sake of market simplicity. Let's look a bit closer at the math in that nodal scenario. Because of that physical constraint, the cheap north node clears at $25, while the expensive south node clears at $70. Boom! That creates a highly visible, highly tradable $45 spread. If you're a congestion trader or a quant on a US desk, that $45 spread is your entire universe. You thrive on forecasting and trading that exact nodal basis using FTRs. But in the zonal market, that spread vanishes into a flat $40 clearing price. You literally have zero locational basis to trade within that zone. Same physics, completely different opportunity set. Section 4. Managing hidden congestion costs. So this brings up a massive question. The physical reality of that binding line didn't just magically disappear because a regulator decreed a single $40 price, right? You still can't push all that cheap northern power south without literally melting the transmission wire. So if the market cleared at a uniform price that actually violates the grid's physical limits, how on earth is the grid kept in balance? Who pays for that? Well, in the zonal market, the grid operator actually has to step in manually after the market clears. They perform what's called out-of-market redispatch.
They literally pay the cheap northern generator to turn down and then pay an expensive, unused southern generator to turn up just to relieve the flow on that stressed line. And guess what? Those actions generate massive costs. Because those costs are totally invisible in the wholesale energy price, they get recovered via socialized uplift. That means every single participant in the market gets a slice of the bill, regardless of whether they actually cause the congestion or not. This opaque cost allocation is exactly why there are fierce, ongoing political debates in Europe right now about bidding zone splitting, basically redrawing the maps to split large zones into smaller ones so persistent bottlenecks finally become visible in the price.
All right, Section 5, Life on the Trading Desk. So what does this actually mean for you? Well, if you're a seasoned trader moving from a nodal market like PJM over to an EU zonal market, you cannot carry your nodal instincts with you. It's a total paradigm shift. Inside a zone, there is no nodal basis to trade. You literally have to unlearn that instinct. Instead, your entire focus has to shift to the edges of the zone. You're going to trade cross-border capacity and monitor interzonal market coupling, which we are going to cover extensively in Module 3. You trade the seams, not the interior. And hey, from an enterprise perspective, your choice of market design completely dictates your technology stack. Your ETRM, your energy trading and risk management architecture, has to perfectly mirror the market. For a US desk, your ETRM must flawlessly ingest and model thousands of individual node pricing streams and complex FTR portfolios. For a European desk, it has to model zonal prices and entirely different cross-border capacity auction structures. And if you're a global trading shop, your dual market platforms must elegantly handle both paradigms simultaneously. Let me tell you from years of experience, this is a massive data and architectural challenge, and it's exactly what we'll tackle head-on when we get to Modules 9 and 11.
Let's wrap things up with Section 6, Pitfalls and Key Takeaways.
Picture this. You're sitting in a high-stakes interview for a senior originations or trading role at a major merchant shop, and they throw this exact scenario at you. They really want to know if you actually understand the structural mechanics beneath the trades you're putting on. You need to clearly articulate the fundamental difference in the tradable opportunity set. You would confidently look them in the eye and answer that nodal markets automatically price congestion directly into locational marginal prices, creating a rich landscape of basis spreads supported by FTRs. You'd then contrast this with zonal markets, which compute a single price that intentionally hides internal congestion. You would absolutely point out that zonal bottlenecks don't just magically disappear. They're handled via costly out-of-market redispatch, which socializes costs across the entire market through uplift. And ultimately, you'd explain that this completely changes your product selection and your risk profile, forcing you to abandon nodal basis strategies and pivot entirely toward cross-border interzonal trading. Nail that, and you're in great shape. Understanding these market structures is the baseline for literally everything we do on the desk. But physical realities definitely have their limits. As you'll see in our next chapter, Chapter 16, whether congestion is explicitly priced at a hyperlocal node or hidden away in massive zonal uplift charges, if a bottleneck gets bad enough and expensive enough, eventually someone just has to step in, dig holes, and build new physical wires. So we'll explore the economics of transmission expansion planning next. Until then, ask yourself, if your market suddenly switched from zonal to nodal tomorrow, would your current trading strategies survive the math? Think about it, and I'll see you in the next chapter.
Welcome back to the Power Trading Desk Master Program. Today, I'm putting on my Durga Analytics consultant hat to walk you through Module 1, Chapter 16, Transmission Expansion Planning. Just as a quick reminder of our overall journey, this program is a heavily sequenced path across 13 modules and 234 chapters. We're covering the whole shebang, from the physical power system and market reality through trading strategy, valuation, analytics and risk management, all the way to execution, ETRM technology, regulation, and building a durable trading organization. Every single module is built around real markets, real numbers, and desk-ready projects. So let's jump right into this explainer.
Before we dive into the numbers, let's quickly orient ourselves. Remember, we're still in Module 1, Power System Fundamentals. But with this chapter, we're making a pretty crucial pivot. We're transitioning from the pure immediate physics of grid congestion, which we covered back in Chapter 14, and stepping directly into the time dimension. And this time dimension, it's exactly what dictates long-term trading strategy and fundamentally alters how you manage risk on the desk over those multi-year horizons.
Okay, let's look at the agenda for this explainer. 1. Why expand the grid? 2. Anatomy of a spread collapse. 3. The timing risk trap. 4. Hedging the basis trade. And 5. Our key takeaways.
Section 1. Why expand the grid?
We absolutely have to start with the physical reality. Why? Because you simply cannot trade financial power effectively over the long term if you ignore the physical copper and steel. It's just impossible. Independent system operators, TSOs, and regulators are out there balancing massive capital costs over incredibly long horizons to expand the grid for 3 core reasons. First, connecting new generation, especially remote renewables like wind and solar that are usually built miles away from load centers. Second, relieving persistent, expensive congestion bottlenecks that just drive up costs for everyone. And third, improving overall system reliability. This expansion isn't random. It's a calculated, forward-looking process that literally alters the fundamental topology of the market.
Section 2. Anatomy of a spread collapse. Now, this is where a physical engineering decision directly impacts a trader's multi-year P&L. Look at that massive drop in 2028. We're tracking a reliable, highly profitable basis spread, sitting super comfortably near $45 per megawatt hour from 2024 right through 2027. But the absolute second a new transmission line goes into service and relieves that binding constraint, boom! The spread gets crushed down to about $12, and it just keeps compressing in the following years. Think about it. If your valuation models assume that $45 spread was permanent, your long-term position just lost millions of dollars overnight. Expansion completely redraws the congestion map.
For any long-dated basis position, a desk has to treat the transmission expansion plan as a primary input. A line in the expansion plan is a known, quantifiable future threat. If you're an originator or a trader holding a multi-year locational position, your core thesis will die if you ignore these plans. You really have to train your instinct to constantly ask, okay, what is being built across my constraint, and exactly when is it scheduled to energize?
Section 3. The timing risk track.
Now, obviously, market reality is never as clean as a scheduled in-service state printed on some ISO planning document. Let's say you're long a south minus north basis spread. You're basically trapped between 2 outcomes here. In scenario A, the plan line arrives perfectly on time in 2028. Like we just saw, this structurally collapses your spread and your trade's thesis dies instantly. But in scenario B, which, let's be real, is arguably more common, the project slips. Due to permitting delays, siting opposition, or crazy cost overruns, that line due in 2028 slips to 2031. Or maybe it never arrives at all. The spread survives longer, which sounds awesome, but it introduces a terrifying reality for a trader. The construction timeline of a physical asset, not the actual supply and demand of power, is now the dominant risk factor in your trade.
Section 4. Hedging the basis trade. So how do you protect the desk from this massive structural uncertainty? You can't just cross your fingers and hope grid operators run late. Let's put this into a practical context. If I'm interviewing you for a senior spot on an FTR, a financial transmission right, desk, and I ask you hold a multi-year position long the basis across a frequently congested interface, what external development could completely destroy your thesis? Your immediate reflexive answers needs to be a new transmission line. And you monitor for it by tracking the ISO expansion pipeline, regulatory filings, and construction progress reports like a hawk. These are your primary forward-looking data inputs.
To survive and actually make money, your enterprise ETRM systems and valuation models must avoid some very common, very lethal pitfalls. Specifically,
Assuming that historical congestion is permanent, blindly trusting a project's stated in-service timeline without some heavy skepticism, and completely ignoring expansion plans in your long-dated positions. Model skepticism is your best friend here, guys. A serious desk maintains an active, proprietary view on the expansion pipeline to generate realistic scenarios for our Module 5 valuation.
Section 5. Key takeaways and next steps.
Ultimately, what you absolutely must take away from this explainer is that transmission expansion completely redraws the congestion map. Those juicy spreads, they're not permanent. Furthermore, project timelines are incredibly long and genuinely uncertain. Because of this, transmission expansion must be a primary scenario input for long-dated locational risk, informing the realism of your nodal models. Missing a planned line or mispricing its delay will absolutely turn an otherwise sound congestion view into a massive desk loss.
Now that you know exactly how physical grid expansion threatens your long-term financial hedges, I want to leave you with a bit of a provocative thought. If these multi-year transmission projects are constantly delayed by permitting and opposition, how do regulators and system operators guarantee the system doesn't just fail in the meantime? Seriously, how do they ensure the lights stay on while waiting for the copper and steel to catch up? Well, that delicate balancing act is exactly what we're going to uncover in our next explainer, Chapter 17 on Grid Reliability Standards. I'll see you there.
Welcome back to another explainer in our Power Trading Desk Master Program. I'm your host, a power trading and risk management consultant from Durga Analytics. Over the decades, I've traded physical and financial power, built desks, and designed ETRM systems. Now, as a quick refresher, this program is a massive sequence journey across 13 modules and 234 chapters. We're currently in Module 1, Chapter 17, Grid Reliability Standards. Today, we're taking the physical grid's engineering rules and bridging them straight to your trading desk's P&L. We're getting past the textbook theories and looking at what actually happens when the grid is pushed right to the absolute brink. Let's get into it.
Here's our roadmap for this chapter. 1. The mandate for reliability. 2. Reserves and N1 planning. 3. Thin reserves drive extreme prices. And finally, 4. Desk reality and fat tails.
Starting right off with Section 1, the mandate for reliability. Why physics overrides economics. So the absolute foundational rule of power markets, and I mean the rule that sits above literally everything else you'll ever model on the trading floor, is that preventing a catastrophic cascading blackout is completely non-negotiable. Now, we spend a ton of time in this industry talking about economic dispatch, right? That perfectly efficient market-driven approach. But the reality? Grid operators are bound by a reliability mandate. It is strictly security-driven, it is non-negotiable, and it will absolutely override pure economics every single time. If your desk's models assume a perfectly efficient least-cost market, well, you're going to be caught completely off guard when the grid operator inevitably steps in.
You have to understand, these reliability standards aren't just polite suggestions. They are fiercely mandated by governing bodies like NERC in North America and ENTSO-E in Europe. The core requirement here is that the system must withstand credible failures without losing load. So when the system gets stressed, these constraints force dispatchers into taking out-of-market actions. They will literally redispatch units completely out of the economic merit order just to keep the lights on. At that point, it's not about finding the cheapest power anymore, is it? It's just about pure survival.
Moving on to Section 2, Reserves and N1 Planning, the grid's essential safety buffer.
Look, every trader on the floor absolutely must understand N1 planning. N1 dictates that the grid has to survive the sudden loss of any single major element. We're talking a massive nuclear unit tripping offline or a critical transmission line suddenly failing, all without causing a systemic blackout. To pull this off, the operator constantly holds back spare capacity. These are your reserves. They're basically keeping megawatts in their back pocket, acting as a mandatory giant insurance policy that goes way beyond what cheap economic dispatch would normally dictate.
And as you know, reliability is definitely not free. You can't just tell a power plant to sit idle on standby without paying them.
These reserves are actively procured through ancillary service markets. This actually links us perfectly back to the market structures we'll cover later in Module 3. The grid operator is out there buying this insurance policy every single day, which creates an entirely separate market layer of supply and demand running right parallel to wholesale energy.
All right, Section 3, thin reserves drive extreme prices when scarcity pricing kicks in.
And this is the exact moment things get totally chaotic on the desk. Watch that teal line, our reserve margin, and the amber line representing the power price. Notice how the price just exponentially spikes the very second that reserve margin drops down toward its minimum allowable threshold, hitting that dashed red line. When operators run out of their safety buffer, administrative scarcity pricing mechanisms automatically fire off. Make no mistake, this is the exact moment where your entire annual P&L is often made or completely destroyed in a matter of hours.
Let's walk through a real-world scenario you'll see on the desk. First, a brutal summer heat wave pushes demand to record levels. The grid is running incredibly hot. Second, 2 large baseload units unexpectedly trip offline. Third, suddenly those reserves fall below that critical N1 margin. The operator is now flying without a net. Finally, step 4, the market scarcity pricing mechanism kicks in. And we're not talking about an extra $10 here. This is an administrative scarcity adder that can catapult prices to $5,000 per megawatt hour or more, right before they start shedding load.
If you're sitting there staring at a $5,000 print on your screen, you might honestly think the market is broken, but it isn't. You've got to remember this absolute rule. When reliability and economics conflict, reliability wins. The operator will redispatch out of merit order to keep the system secure. None of this extreme price action is irrational. The market is just explicitly valuing the avoidance of a total blackout way above standard economic efficiency.
Which brings us to Section 4, Desk Reality and Fat Tails, Surviving Scarcity on the Trading Floor.
When you are operating on a modern power desk, forecast reserves are literally your fuel gauge for extreme volatility. The best, most experienced traders don't just look at demand forecasts, they obsessively watch the reserve margin. When extreme weather meets unexpected outages and that fuel gauge starts getting dangerously thin, your immediate instinct has to be to expect scarcity pricing, because you know for sure that's the trigger point where the grid's reliability layer overrides normal economics.
From an enterprise risk management perspective, these reliability-driven scarcity events are the absolute fat tails of your P&L distribution. If you are building models for scenario generation, which we tackle in Module 5, or setting up stress testing frameworks for Module 7, you absolutely must explicitly model these reserve shortfalls and scarcity adders. If your ETRM system or your quantitative models fail to capture this administrative pricing behavior, your value at risk is going to drastically understate your true risk. You'll be reporting a perfectly manageable VAR right up until the day a reserve shortfall completely blows up your desk.
And that leads us directly into the most common pitfalls for analysts and risk managers. The biggest mistake? Modeling only a clean, normal operation supply stack. It's assuming that the free market always clears economically based on marginal cost, and vastly underestimating that scarcity price caps can reach thousands of dollars per megawatt hour. If you make these mistakes, you end up treating these massive P&L-defining spikes as inexplicable data anomalies, rather than the engineered, deliberate rules of the grid that they actually are. So I want to leave you with a critical challenge for your own desk. When electricity prices spike to several $1,000s per megawatt hour, does your ETRM system view that as a broken market anomaly, or as the grid's reliability engine working exactly as it was designed to? A desk that understands this anticipates the chaos. A desk that doesn't just gets completely run over by it. Keep this top of mind as we transition directly into Chapter 18 on load forecasting, where we'll learn how to anticipate the very demand spikes that drain these reserves in the first place. Thanks for joining me on this explainer, and I'll see you in the next one.
Welcome back to The Explainer. I'm your host, And as a veteran consultant here at Durga Analytics, I've spent decades navigating physical and financial power markets, building out trading desks, and designing enterprise systems. Today, we're stepping back into the Power Trading Desk Master Program to tackle an absolutely critical piece of our daily market reality: load forecasting. This is Chapter 18. Here is a quick look at our agenda. We'll cover our program context, why load forecasting matters, the core drivers of demand, a real-world 3 gigawatt miss, why forecast error is price risk, and finally, enterprise integration. Let's dive in. Section 1. Program context, where we are. Just to ground us, remember that the Power Trading Desk Master Program is this sequenced journey. We're talking 13 modules, 234 chapters total, covering everything from the physical grid all the way through execution, risk, and ETRM tech. Right now, we're wrapping up Module 1, which is Power System Fundamentals. Chapter 18 here serves as this crucial bridge. We're taking all those physical grid mechanics we've covered, like merit order dispatch from Chapter 7, and connecting them straight to the real-world trading reality you're going to face on the desk every single day. Okay, Section 2, why load forecasting matters. There's this saying we use on the desk: demand is half of every price. It sounds almost too simple, right? But it is deeply profound. You see, we spend so much of our time analyzing supply. We're tracking unit outages, monitoring fuel costs, checking constraints, that it's dangerously easy to forget demand is the actual force pulling that supply into the market. It's the invisible hand triggering those unit commitments. Demand is one of your two main price drivers. So missing the load forecast, that means you're fundamentally mispricing the market. It's really interesting to contrast the perspectives here. To a grid operator, forecasting load is fundamentally about physics, right? They need to forecast demand to commit units and keep the lights on. But to a trader, it's entirely about economics. A trader forecasts load to anticipate price. Everything downstream depends on that forecasted demand. If your desk has a better, more nuanced forecast than the rest of the market, well, you've got a direct, actionable commercial edge. Section 3. Drivers of electricity demand. So what actually moves the needle? There are 4 main drivers you need to master. First, and absolutely the most critical in the short term, is weather. Temperature just dominates. Heating load in the winter, cooling in the summer. And it's not just the raw temp. Things like humidity and cloud cover massively change the perceived temperature. Second is the calendar. Time of day, day of the week, holidays, they create these strong, learnable patterns. Third is economic activity, where industrial and commercial load tracks the broader economy over months or quarters. And finally, structural shifts. Think electrification, like electric vehicles or heat pumps. Over a span of years, these shifts actively change our baselines, making your old historical data pretty unreliable. Now, forecasting spans 3 distinct time horizons. You've got the very short term, minutes to hours ahead, which is used almost exclusively by operators for real-time grid balancing. The long term looks years out for capacity planning. But on the trading desk, we are hyper-focused on the short-term horizon, day ahead out to a few weeks. This is the precise timeline that drives prompt pricing, and that is exactly where positions are taken and money is made or lost. Section 4. The 3 gigawatt forecast miss. I want to anchor this in a real-world scenario to show you the stakes. Imagine a massive 3 gigawatt forecasting miss. Let's say an unexpected, brutal, humid, hot afternoon rolls into the region and completely catches the market off guard. Let's step through the fallout. Day ahead, the load is forecasted to peak at 38 gigawatts. Your desk positions for that, assuming a moderate clearing price. But then that heat hits, and the actual peak climbs aggressively to 41 gigawatts. Remember that merit order dispatch curve? The system is forced to move way up that curve. That extra 3 gigs of demand, it doesn't come cheap. It has to be served by expensive, fast-ramping peaker plants, like older gas turbines. Suddenly, real-time prices just explode exponentially above the day-ahead price. In this scenario, a desk that's long real-time profits immensely, but a desk caught short or just leaning on a bad forecast, that's a massive career-altering loss, and it all traces back to a simple weather miss. Section 5, Forecast Error is Price Risked. The key to grasping this is visualizing the uncertainty band around the central forecast line. Think about a plus or minus 2 gigawatt gap around your expectation. That gap, that uncertainty, is exactly what the physical system and your financial position has to absorb. Technically speaking, forecast error is just actual load minus forecasted load. But in practice, it is the direct driver of system imbalance and real-time price shocks. That central number is just a statistical estimate. The error band? That's the volatile reality you actually have to trade around. So here is the absolute crucial desk insight. A position is implicitly a bet on the load forecast being right. When a seasoned trader reads a forecast, they don't just accept the number. They immediately ask, what is the weather risk to this central estimate? If a forecast is fragile to a sudden temperature spike, that is a flashing price risk signal. Knowing the forecast's uncertainty is literally knowing your position's risk exposure. Section 6, Enterprise Integration and Takeaways. Now, running a robust desk requires a healthy dose of model skepticism, and there are some common pitfalls you absolutely have to avoid. The deadliest trap? Obsessing over the central point forecast while ignoring the uncertainty band. Do that, and you are totally mispricing your risk. Another one is underweighting weather. Temperature is your dominant short-term driver. If your model doesn't respect it, you're going to get burned. Lastly, ignoring those structural shifts. If you just rely on historical data without factoring in massive changes like EVs, your quantitative models will be fundamentally blind to the future grid. So, how does this fit into our broader program? Well, load forecasting isn't just theory, it's a core analytics capability. The principles we just covered will directly feed the demand inputs for your Module 1 grid simulator project. Later on in Module 5, this same forecast uncertainty is going to heavily drive our value-at-risk scenario generation. And when we hit Module 6, we'll treat load forecasting as a central data engineering and machine learning problem, moving way past simple regressions. I want to leave you with a classic desk interview question to lock this in. Why does a trader care about the uncertainty around a load forecast, and not just the central number? Well, because the trader's actual commercial risk lives entirely in that uncertainty band. The physical system balances economically to the forecast, but when actual load deviates, the marginal cost of generation skyrockets and prices move violently. Next time, in Chapter 19, we'll apply this exact same rigor to the supply side as we dive into renewable forecasting and intermittency. Until then, stay disciplined and I'll catch you in the next explainer. Welcome back to the Power Trading Desk Master Program. I'm your host and consultant from Durga Analytics. We're continuing our sequence journey across this massive 13-module, 234-chapter program where we're building everything from the ground up, starting with the physical power system and market reality, moving through strategy, valuation, and risk, all the way to enterprise ETRM technology and designing a durable trading organization. Right now, we're wrapping up Module 1, Power System Fundamentals. And in Chapter 19 today, we pivot from physical systems to explore how weather-driven supply is rapidly replacing gross demand as the absolute dominant source of market uncertainty. If you want to survive and protect your P&L on a modern trading desk, you absolutely have to master renewable forecasting. Here's our agenda for this explainer: the desk reality check, weather and conversion risks, the horizon trap, real-time price impacts, mastering net load, and we'll wrap up with our key desk takeaways. Section 1. The desk reality check. Imagine staring at your screens on a trading desk. A perfectly mild sunny day ahead weather forecast gives you this really dangerous illusion of certainty. Historically, the biggest variable a desk had to worry about was consumer demand. But as renewables grow to dominate the grid, that entire script has flipped. Today, a wind or solar forecast error moves the market just as violently, and often way worse, than a demand error. Because renewable output is entirely weather-driven, forecast quality is a brutal make-or-break reality. If your quants and analytics team get this wrong, well, you're exposing your book to massive financial pain.
Section 2. Weather and conversion risks.
So, we need to unpack exactly why predicting this output is structurally so much harder than traditional load forecasting. If you remember from Chapter 18, consumer load follows deeply predictable human calendar patterns. People wake up, they make coffee, they turn on the lights at roughly the same times every single day. Forecasting renewables is a completely different beast, mostly because you're stacking two distinct layers of uncertainty. Step 1 is forecasting the inherently chaotic weather itself, wind speeds, cloud cover, pressure systems. Step 2 is translating that raw weather data into actual megawatt output using the specific, highly nonlinear power curves of the turbines and panels in that exact location. It's a compounding error problem, and it can snowball incredibly fast.
Section 3. The horizon trap.
Think about how this stacked uncertainty fans out over time. You might have a neat central forecast line. That's the single point estimate your vendor hands you. But surrounding that central line are these rapidly expanding statistical cones of uncertainty. In high renewable markets, those widening bands represent the actual, terrifying financial risk your day-ahead position carries right into real time. While a renewable forecast for the next hour is fairly reliable, by the 2-day mark, that risk cone is just massive. And here's the trap. Day-ahead market commitments rely on forecasts made when that uncertainty is still incredibly large. You're locking in hard financial obligations when the meteorological models are practically admitting they have no real idea what the wind will actually do 48 hours from now. It's honestly a bit like signing a contract blindfolded.
Section 4. Real-time price impacts.
Now, theory is great, but let's see how this actually hits the P&L. Let's say day-ahead wind is forecast at a robust 7 gigawatts. The market commits accordingly, expecting plenty of cheap supply and very soft prices. But fast forward to real time, and a high-pressure system suddenly stalls out over your region. Actual wind drops to just 2 gigawatts. You suddenly have a massive 5-gigawatt hole that literally no one priced into the day-ahead market. For a power trader, this is the exact definition of a very bad afternoon. When that 5-gigawatt hole opens up, the grid operator must immediately scramble to pull in fast, extremely expensive peaker generation just to keep the lights on. Real-time prices absolutely spike. A desk that anticipated the lull risk or maybe positioned themselves long in real time makes an absolute fortune. But a desk that blindly trusted the day-ahead forecast, they get wiped out in a balance settlement. This is precisely why seasoned risk managers will always ask one vital question before signing off on a position. What if the wind forecast busts? Section 5. Mastering net load. To survive these real-time busts, your desk has to completely rethink what it's analyzing. The critical question isn't what total gross consumer demand will be anymore. That's old-school thinking. The real question is, what demand is left over after wind and solar produce whatever they are randomly going to produce? That leftover piece is what the rest of the dispatchable stack, the gas, the coal, the hydro, actually has to ramp up and serve. And that brings us to a foundational equation for modern power trading: net load. Net load simply equals gross demand minus renewables. This is the actual quantity the dispatchable stack must serve. By using net load, or taking load forecast uncertainty and renewable forecast uncertainty and combining them into a single, highly tradable metric. Because net load uncertainty is so heavily dominated by volatile renewables, successful desks rely entirely on probabilistic distributions. As we'll cover deeply in Module 6 on Analytics and AI, trading on single-point estimates is incredibly dangerous. You absolutely need to model the full distribution, the entire cone of uncertainty, to generate scenarios and accurately price your risk. Why? Because the central estimate is almost never what actually happens.
Section 6, Key Desk Takeaways.
Let's consolidate this into some hard, actionable rules for your analytics and trading models. Renewable output stacks weather and conversion uncertainty. That uncertainty grows massively with the horizon, which leaves day-ahead forecasts highly vulnerable. When they bust, they drive extreme real-time volatility. So, sizing your positions against weather risk, trading net load instead of gross demand, and using probabilistic distributions, these are non-negotiable for survival on the desk. You can never, ever treat a day-ahead renewable forecast as a guarantee. We've mapped out the sheer financial risks of forecasting, but that leaves us with a truly fascinating operational reality. If forecasts are this volatile, and a 5-gigawatt swing can happen in a single hour, how does the grid operator physically keep the lights from going out before those backup thermal plants even have time to spin up? That is exactly what we're going to tackle next in Chapter 20, Intermittency and Balancing. I'll see you there. All right, let's jump right in. Welcome back to the Power Trading Desk Master Program. If you're new here, we are on a massive 13-module, 234-chapter journey covering everything from grid physics all the way to enterprise ETRM architecture. I've got my Durga Analytics Consultant hat on today, bringing decades of trading floor experience straight to your screen. Today, we're tackling Module 1, Chapter 20, and this is a big one. We are going to build a bridge between the actual physical reality of the power grid and the financial reality of your P&L. Because let me tell you, for anyone building a career on a power desk, whether you're trading, modeling, or managing risk, understanding this bridge is the literal difference between a desk that thrives and one that hemorrhages cash. So, let's kick things off with a pretty critical question. What exactly happens to your P&L when the physical grid hiccups and goes short on supply for, say, just a few seconds? You know, most textbook models just look at power in these neat, tidy, hourly or half-hourly blocks. But guess what? The grid doesn't care about blocks. It operates in real time, literally second by second. When a massive cloud rolls over a solar farm, the grid feels it instantly. And if you are scheduling power or managing an intraday position, that physical reality translates immediately into your short-term imbalance settlement prices. It's fast and it is unforgiving. Here is our quick roadmap for this explainer. We'll start with our program context, dive into grid frequency, break down the hierarchy of reserves, analyze the anatomy of a 2-gigawatt drop, and finally, tie it all back to flexibility and desk risk. Okay, part 1. Let's quickly orient ourselves within the wider program. Like I mentioned, we're deep into Module 1 right now, specifically Chapter 20. And this material builds directly on the slower economic dispatch concepts we covered back in Chapter 9. Think of it this way. If economic dispatch is that slow, deliberate decision you make over your morning coffee, balancing is the lightning-fast, spill-your-coffee reality of what is actually happening on the wire right now. Moving to our next core concept, grid frequency, which acts as the system's ultimate physical alarm bell. Think about how this plays out continuously in real time. Frequency is constantly drifting around a target, 50 Hz here, which is standard in Europe, though obviously it's 60 Hz in much of the Americas. The golden rule is that supply absolutely must equal demand at every single instant. So the system operator is just constantly adjusting generation to track demand as it drifts. And this balancing act, it's never actually done. It only stays inside that safe operating band because of a highly active, totally relentless control process. In an AC system, these frequency deviations are quite literally the physical alarm bell of an imbalance. The rule is super simple, but man, the financial implications are massive. If demand exceeds supply, frequency drops. If supply exceeds demand, frequency rises. The system operator has to use fast-responding resources to violently yank that frequency back to the target. And for a prompt desk trader, this isn't just fun engineering trivia. This is the exact underlying mechanism that generates ancillary service value and completely dictates your short-term imbalance prices. All right, section 3, let's look at the mechanics of how the system actually responds, the hierarchy of reserves. So the grid basically relies on a layered defense mechanism. It's a hierarchy that responds at different speeds. First up, you've got a very fast automatic response to arrest an instantaneous deviation. We're talking seconds here. Then slightly slower reserves step in for the sustained imbalances to shoulder the load. And finally, the system operator officially redispatches the system to reset the overall balance. Every layer seamlessly hands off to the next just to keep the grid from totally collapsing. But here is the kicker for us on the desk. These responses aren't just acts of engineering goodwill. No way. They are explicitly procured, heavily priced balancing services. Balancing has real market value. Generators and storage assets that can respond fast earn serious money providing this service. When we're talking about asset valuation or managing intraday risk in your ETRM, this is the exact revenue stream we are trying to capture. Let's make this concrete. Section 4 will walk through the anatomy of an actual 2 gigawatt drop. Picture this. You've got a massive bank of solar farms. Bright, sunny day, everything is running totally smooth. And then a heavy cloud cover just rolls in out of absolutely nowhere. Boom. 2 gigawatts of output drops off the grid in a matter of minutes. And honestly, this is exactly the kind of massive swing that intermittency makes way more frequent today. Now, because customer demand out in the real world hasn't magically dropped just because the sun went behind a cloud, the system is instantly 2 gigawatts short. The frequency takes a really dangerous dip. Alarm bells are ringing. The system operator is suddenly in a high-stakes race against the clock to replace 2 whole gigawatts before the entire grid destabilizes. Within seconds, fast reserves and battery storage inject power to halt that fall. Then, those slower reserves take over while the operator officially redispatches. Every single layer of this response is a distinct balancing service with a price tag attached. This event right here proves exactly why flexibility gains immense value as intermittent renewables grow. A flexible asset that provided that fast response just earned a massive premium. If your desk controls that asset, you just made bank by solving the grid's physics problem. Which brings us to Section 5. Let's talk about the desk realities of flexibility and risk. As renewables make our net load wildly variable and way less predictable, balancing just inherently becomes harder, and that makes flexibility a highly prized, highly tradable commodity. We're talking fast generation, big batteries, demand response. The whole energy transition isn't just about clean power. Structurally, it's a massive explosion in the value of being able to balance that power. Trading desks are explicitly valuing flexibility more and more, simply because the prices paid for meeting these real-time needs are skyrocketing alongside intermittency. Here's the ultimate reality check for you. Even though this balancing happens in sub-seconds, via automated systems that you will never manually touch as a trader, the costs of those automated actions show up directly and painfully in your short-term imbalance settlement. Real-time imbalance data feeds straight into your intraday risk systems, and the real-time analytics we're going to build out in Module 6. You absolutely have to understand the grid physics to model the finance. Okay, let's talk model skepticism and a few common pitfalls, especially if you're interviewing for a desk role soon. Please, whatever you do, avoid the rookie mistake of confusing this real-time continuous balancing with the slower block-based decisions of economic dispatch. Dispatch is how much to run over the next hour. Balancing is the lightning-fast control layer running beneath it. Also, never ignore frequency as the basis for fast response value. And definitely don't underrate the structural trend here. As renewables grow, balancing needs grow. End of story. All right, let's wrap this up with some key takeaways. To survive and actually make money on a modern power desk, you've got to internalize this. Balancing is continuous. It happens beneath dispatch. Grid frequency is the physical signal of that balance. Falling when we're short, rising when we're long. the system responds with a hierarchy of reserves that are explicitly priced in the market. And the big takeaway for your P&L? As renewables eat up the generation stack, the sheer mathematical need to balance their intermittency creates growing, highly lucrative revenue streams for fast-responding, flexible assets. So, as we close out this explainer, I want you to take a hard look at your own desk. How are your current models pricing this sub-second flexibility? Are your risk and ETRM setups actually capturing this value? Or are you still blindly relying on outdated hourly block models? It is a make or break question for modern traders, and it's exactly the question we're going to answer in detail when we transition into Chapter 21, Storage Economics. I'll see you over there. Welcome back. In this explainer from Durga Analytics, we're taking textbook theory and turning it into desk-ready strategies. I've spent decades on the trading floor, building desks and designing ETRM systems, and my goal here is to bridge that gap between the physics of the grid and your trading desk's bottom line. Today, we're diving into literally the fastest-growing, most fascinating, flexible resource out there on the grid right now. We're talking about storage. Let's get right into it. Just as a really quick reminder of where we are in the Power Trading Desk Master Program. We are on a massive sequence journey together. We're talking 13 modules, 234 chapters, taking you all the way from raw grid physics and market reality through valuation, strategy, and risk, all the way to execution and designing a truly durable trading organization. Here is our roadmap for today. We'll start with the master program roadmap, define the storage asset, break down the real arbitrage math, look at stacking revenue streams, dive into an intertemporal dispatch, and finally discuss reshaping the future grid. All right, Section 1, the Master Program Roadmap. Let's get ourselves situated. So we are currently wrapping up Module 1, Power System Fundamentals, specifically Chapter 21, Storage Economics. Up to this point, we've covered the thermal stack, hydro, wind, solar, and the mechanics of economic dispatch. Now we're looking at the missing link, batteries. This is where we make that massive shift from simply generating power to actually moving it across time. It's a real game changer for any desk. Moving on to Section 2, defining the storage asset. Let's nail down the foundational parameters you absolutely need to know. When you're sitting at the desk sizing up a battery asset, you've got to understand its physical constraints before you ever put a trade on the board. First up is power, measured in megawatts. Just think of power as the size of the pipe. A 100-megawatt battery can push exactly 100 megawatts onto the grid or pull 100 megawatts off of it at any given second. It's your maximum flow rate. The second big parameter is energy, which we measure in megawatt hours. If power is the size of the pipe, energy is the size of the tank. So a 200 megawatt hour capacity means our 100 megawatt battery can run at absolute full tilt for exactly 2 hours. That's what defines the duration of your asset. And look, physics is physics. You simply cannot squeeze 3 hours of full output out of a 2-hour tank. Now, here's the parameter that always catches the rookies off guard. Round trip efficiency. That's energy out divided by energy in, and spoiler alert, it is always below 100%. This is absolutely crucial, because round-trip efficiency isn't just some abstract physics concept. It is a direct, unavoidable drag on your P&L. Because of heat and conversion losses, you literally have to buy more power than you can sell back. It acts as a permanent toll on your arbitrage strategy. Section 3, the real arbitrage math. Let's see how theory meets the trading screen. This perfectly illustrates the basic strategy. You're looking at the classic daily price shape, totally driven by solar generation. Yeah, the infamous duck curve. The goal here is pretty simple. You charge up your battery during those incredibly cheap midday solar belly hours. Then you hold on to that power and discharge it right into the super expensive evening peak. You're doing exactly what traders always do, buying low and selling high, but you're doing it across time instead of geography. Let's run a real desk example. Say you've got a 100 megawatt, 200 megawatt hour battery with an 85% round trip efficiency.
Let's imagine the midday price is $20 a megawatt hour, and the evening peak spikes to $120. To sell your full tank, all 200 megawatt hours at the peak, you actually have to buy about 235 megawatt hours during the day. Why? To pay that 15% efficiency toll we just talked about. So your charge cost is $4,700 and your discharge revenue hits $24,000.
Subtract your $4,700 charge cost from that $24,000 peak revenue, and you are left with a gross arbitrage of $19,300 for just a single daily cycle. But keep in mind, that is strictly gross profit. That's before we even start talking about battery degradation, cycling limits, or fixed costs. But hey, in this specific scenario, that fat $100 price spread comfortably covers your efficiency toll.
Let's jump to Section 4, stacking the revenue streams. Because what happens on a breezy Tuesday when wind generation is high, load is low, the price curve goes totally flat, and that beautiful $19,300 just evaporates? Well, this is exactly why real desks stack multiple revenue streams. A battery does not, and really cannot, survive on energy arbitrage alone. In a lot of markets, it's actually fast balancing, frequency response, and ancillary services that make a battery's pay. Because they can respond to grid frequency deviations in literal milliseconds, batteries are incredibly valuable for grid stability. Throw in some capacity or reliability payments just for being available during critical hours, and suddenly you're managing a very complex, multi-layered revenue stack. Which brings us to Section 5. Intertemporal dispatch optimization. This is the big one. The operational challenge here is exactly what separates the rookies from the survivors on a desk. A naive spreadsheet model, it looks at dispatch myopically, literally hour by hour. It just looks at the screen and says, hey, is the price right now higher than my cost to charge? But a true enterprise ETRM system run by a professional desk treats storage as an intertemporal dynamic programming problem. Think about it. Your tank is limited. You only have 2 hours of juice. You can't just discharge whenever prices are okay. You have to optimize over the entire expected price path for the day, or even the whole week, saving your limited energy for the absolute highest value hours, all while factoring in degradation. It's like a giant puzzle. Look, if you're interviewing for a trading or analyst desk tomorrow, this is the classic test they're going to throw at you. 100 MW, 200 MWH, 85% round trip. You have to be able to define what each figure means and estimate a day's arbitrage value on the spot. You define the power limit, the energy duration, and the efficiency drag. And when you're estimating value, you absolutely cannot ignore that round-trip efficiency penalty. And you've got to point out that a naive peak minus trough calculation usually completely misses those lucrative balancing revenues.
Okay, Section 6, reshaping the future grid. Let's zoom out and look at the macro picture.
Storage is so unique because it isn't just a participant in the market, it's actively reshaping it. It's the natural partner to intermittent renewables, right? But here's the catch. As storage deployment grows massively to soak up all that cheap midday solar, it actually flattens out the very duck curve it relies on to make money. By constantly buying the dips and selling the peaks, batteries literally arbitrage away the price shapes. This means storage is permanently altering the very price distributions your desk is going to be trading against in the future.
And this is how it all ties back together in the master program. The intertemporal math we're using here for batteries, it is the exact same underlying structure as the hydro-water value optimization we covered way back in Chapter 5. This foundational knowledge bridges us directly into the advanced dynamic programming and stochastic optimization we're going to build in Module 6. Plus, it sets us up for the highly complex battery degradation modeling we'll tackle in Module 12 when we talk about building a truly durable desk.
So I want you to think about this question as we wrap up Chapter 21. If widespread storage eventually arbitrages away all the daily price spreads, what is your desk's edge going to be tomorrow? Will it be superior forecasting, faster ancillary response, maybe better degradation management? Keep that front of mind as we move to the final piece of the Module 1 puzzle. Next up, in Chapter 22, we are looking at the other side of the flexibility coin, demand response. And get ready, because in Module 2, we are stepping directly onto the trade floor to start running the desk itself. I'll see you there. Welcome back, everyone. I'm your instructor, a power trading and risk management consultant from Durga Analytics, and we're jumping right into Chapter 22 of our explainer for the Power Trading Desk Master Program. As a quick refresher, this program is a sequenced journey across 13 modules and 234 chapters. We're covering the whole shebang, from the physical power system and market reality through trading strategy, valuation, analytics, and risk, all the way to execution, ETRM technology, and the design of a durable trading organization. Each module is built around real markets, real numbers, and a desk-ready project. Today, we are wrapping up Module 1, Power System Fundamentals, with a deep dive into demand response. This is it, our Module 1 finale. We've spent the previous chapters building up our understanding of the generation stack, thermal economics, hydro, intermittency, and storage. But before we cross over into the day-to-day realities of running a trading desk in Module 2, we need to master the final, absolutely crucial piece of the physical systems flexibility toolkit. Honestly, you simply cannot run a profitable trading desk or build a robust risk model without understanding how modern demand reacts to price.
So here's our agenda for today. 1. Flipping the demand assumption. 2. 3 types of demand response. 3. The economics of peak shaving. 4. Desk reality and model pitfalls. And 5. Connecting to ETRM systems.
All right, Section 1. Flipping the demand assumption.
As a consultant who's trained a lot of analysts over the years, I can tell you this is where we have to fundamentally challenge the assumptions junior traders make when they first hit the desk. Traditionally, we treat load as a totally fixed variable, right? The old school mindset is that supply just has to stretch and contort itself to meet whatever the load dictates. But demand response, or DR, flips that entirely. It turns load itself into an active, dispatchable resource. The paradigm shift is massive here. Consumers are reducing or shifting their consumption in response to high prices or system signals. And by doing that, they're essentially acting exactly like a generator that produces power simply by not consuming it.
So, you need to internalize this golden rule if you want to survive on a modern trading desk. A megawatt of avoided demand at peak is as valuable as a megawatt of generation. Period. Cutting load precisely when the grid is most stressed is financially and physically equivalent to firing up a brand new power plant. From a system operator's perspective, they do not care if they get an extra megawatt of supply from a gas turbine or one less megawatt of demand from a factory shutting down. The balancing math is exactly the same, but getting it from the demand side, that's often significantly cheaper.
Moving on to Section 2, 3 types of demand response. So how does this actually happen out there on the grid? Well, we see load react in 3 distinct ways, and you've got to understand the mechanics of all 3 for your pricing models. First up, price-based DR. This is where consumers react to real-time prices or time-of-use tariffs by voluntarily cutting or shifting their load. Then we have incentive-based DR, which is huge for heavy industry. Think of a massive manufacturing facility signing an interruptible contract. They're literally getting paid a capacity fee to sit on standby and shut down operations when the grid operator calls them. And finally, automated or fast DR. This is the new frontier. Smart thermostats, industrial processes, EV chargers that respond automatically and instantly to grid signals. Because it's practically instantaneous, this form of DR has a massive impact on fast balancing markets with 0 human intervention required.
Let's look at Section 3, the economics of peak shaving.
We need to translate this physical mechanism directly into P&L and market pricing, because let's face it, that is what moves the needle on your desk. Take a look at how this plays out. If you look at a standard demand curve, you've got that dangerous peak, that amber section at the very top. By shaving off that top layer with demand response, the system completely removes the need to turn on the absolute most expensive, least efficient peaker plants in the generation stack. Those peak hours drive a wildly disproportionate share of market costs and portfolio risk. So even a modest amount of DR right there has an absolutely outsized effect on the clearing price.
Let's put some real numbers to this. Imagine our desk is forecasting a painfully tight evening peak. The wind just dropped off, demand is surging, and your initial model threatens to push the marginal price into brutal $400 per megawatt hour peaker territory. If you're caught short in your portfolio right now, just staring at the screens as the price spikes, the pain is visceral. That's a highly dangerous situation that can literally wipe out a month of P&L in a single hour.
But wait, what if the system operator activates 1.5 gigawatts of incentive-based industrial curtailment? The factory's power down. That nasty evening peak is instantly shaved off. And because we didn't have to turn on those extraordinarily expensive peaking units, the marginal unit suddenly drops right back down the stack to a standard $90 per megawatt-hour gas plant. The consumers who were paid for curtailment get their incentive, the system avoids the worst of the scarcity spike, and the peak price settles materially lower. Listen, if your desk's analytical model didn't factor in that demand response, you would have completely mispriced that hour, either missing out on a lucrative opportunity or taking on a massive, totally unnecessary risk.
Which brings us perfectly to Section 4, Desk Reality and Model Pitfalls.
Now, let's put on our risk management hats and talk about where this can all go horribly wrong on the desk. In professional trading, you have to practice model skepticism. If you completely ignore DR and just assume demand is fixed, your models are going to dramatically overpredict the height of price spikes. You'll be terrified of risks that won't actually materialize, and you'll end up paying exorbitant premiums to hedge phantoms. But actually, scratch that. The mistake on the other side is just as bad: overestimating DR availability. You cannot assume DR is infinite. You can't assume it's instantly callable or that it'll always be there when you need it most. Real-world DR has hard physical limits. Sometimes it's slow to respond, and industrial players have strict limits on how many times a year they can even be interrupted. Sound modeling on a live desk is all about balancing those two harsh realities.
Finally, let's hit Section 5, connecting to ETRM systems.
How do we actually capture all this operational complexity? Well, this brings us to a major structural shift happening right now in modern trading technology. Enterprise ETRM, that's Energy Trading and Risk Management, and analytics platforms can no longer get away with just modeling physical power plants as simple, isolated nodes. To accurately capture today's market, your technology architecture absolutely must be designed to handle aggregated demand-side resources entering the balancing markets. Increasingly, we're modeling these as tradable virtual power plants, or VPPs. It is a massive shift in how we structure data, risk limits, and dispatch schedules within our enterprise systems to ensure the desk isn't just flying blind.
All right, let's wrap this up with our key takeaways. Demand response fundamentally makes load a dispatchable resource. It comes in three forms: price-based, incentive-based, and automated. Financially, its main job is shaving those peaks and crushing massive price spikes. Always remember the golden rule: 1 megawatt of peak demand response is just as valuable as 1 megawatt of generation. Ultimately, treating demand response as a vital part of your supply-side calculus completes your flexibility toolkit, right alongside balancing and storage, keeping your models accurate and protecting your portfolio. As we close the book on Module 1's physical fundamentals, we are fully primed and ready to begin Module 2, running a power trading desk. So I'm going to leave you with this final thought. In a grid increasingly dominated by intermittent renewables and dynamic load, how will you accurately model flexible, price-responsive demand as you step onto the trading desk tomorrow morning? Think about it, because your edge in the market depends entirely on your answer. Thanks for joining me on this explainer, and I will see you in Module 2.